Fed to cut rates in June. Constance, I'm pleased to say, joins us now for more. Now, Constance, of course, this capitulation from the market, not just driven by Fed guidance, but reinforced by economic data, something that you've said a few times. At inflection points, it's difficult to distinguish between noise and signal. What's the signal in the data in the last 2 months?
Yeah, so I mean, look, we had that stronger January jobs number, which I think is what really kicked off this readjustment in market expectations, right? Because the Fed had begun to speak, speakers had begun to talk about this balanced risks. And at the end of 2023, we saw a narrowing of the breadth of hiring within the labor market. And so I think people were a little surprised by the January number. Now, it's very unwise to judge your entire view by one number, and jobs are a lagging at best, or coincident at best, but often lagging indicator. So when we add in things like hours worked, maybe January was weather, but we see a downward trend. We really have to see a little more data to see what was going on with January. Then you layer on what happened with the inflation data. Now, there was an upside surprise in OER. We had a little wrinkle yesterday. The BLS sent out an email to Laura Rosner on our team, who was our inflation guru and is really responsible for doing our inflation forecasting, which said that they increased the weighting for OER, or single family rather, over multifamily, which may have contributed to that upside surprise. It'll be very interesting to see what happens with PCE today. But the bottom line is, even if we get 0.3 month over month on PCE today, we do expect PCE to move down to 2.1% by May, and the Fed will have that data, and so it is likely they will begin to cut in June.
You know, I got to say, there was a chart from Bespoke Investment Group yesterday that really stunned me, that showed that the total cumulative easing, even with basically moving sideways over the past few months, the total cumulative easing in financial conditions in the U.S. over the past 4 months ranks as one of the most significant periods of relaxing financial conditions since at least 1982. How much is the promise of rate cuts essentially moving against the Fed's goal of 2% inflation and really putting the goalpost much later in the year?
Yeah, that's a great question. I mean, look, for households, I don't think they're experiencing that easing. So if you look at mortgage rates, they're at historic wide spreads over the 10-year. And that's, of course, because we have this inverted yield curve and the prepayment risk is very high. If you look at credit card rates, those are higher. You look at auto financing rates, they're coming down ever so slightly, but they're still pretty high. So yes, for Wall Street, you see an easing of some conditions, and obviously the higher stock market helps with wealth effects, and that overall impacts financial conditions. But I would say for Main Street, you're still seeing a pinch.
Which raises this question: how long do rates have to stay at this level before a soft landing looks less likely?
Yeah, well, this is where the data becomes really interesting, and where focusing in that February jobs report is going to be widely picked over. We have a scrubbing mechanism that we do of earnings reports, and we look at intentions to hire and intentions to fire. And what we're seeing for the first time is that intentions to hire are falling and intentions to fire are rising. Now, that's being made up for in smaller companies. We have still a record number of new business formations that have intention to hire people. So large listed companies, people are moving out of those companies and getting jobs elsewhere in the economy. But if we see labor hoarding come to an end, that is a worrisome sign, because you're going to start to see weaker and weaker jobs prints.
So, Constance, with that in mind, given what you've just said, do you believe the bigger risk right now is holding too long? And
right, they weren't balanced before. They just started saying that. And I think the risks are balanced between weakness on the real economy side, and as evidenced by jobs data, and inflation possibly not coming down as fast as people had hoped.
They seem to be worried that maybe the progress we've made, the disinflationary trends of the last 6 months, might be due to one-off factors. You seem to have more confidence about this glide path back towards 2%. What is durable about the disinflationary trends of the last 6 or so months, Constance, from your perspective?
Yeah, I mean, look, when we dig into all the details, right, there are certain things that each month one thing will move higher, whether that's medical costs, whether that's insurance costs. Now, one of the things that we're pretty sure of is that the housing component is going to start to moderate, and we see that in the rent data, right? And so we have this disconnect in terms of the timing of when that shows up in the CPI and PCE and when it's showing up real time in the market, and that is going to be a significant driver. In addition, we expect goods prices to remain soft. Now, there's been some verbalized concern that perhaps the softness in good prices won't continue, and of course, if that doesn't continue, that would be problematic for a June cut.
So one to watch tomorrow morning, 8:30 Eastern Time, the latest PCE deflator, the Fed's preferred gauge of inflation, tomorrow morning at 8:30 Eastern. Constance, we've got to leave it there. Wonderful to hear from you. Constance Hunter there of Macro Policy Perspectives. I keep going back to Governor Waller. Ramo, what's the rush? And I think that's what you heard there, that ultimately there's a little bit of confidence about this glide path back towards 2%, but at the moment, given the economic data we've had so far this year, what's the rush?
And we heard the same from Fed Governor Bowman yesterday, saying that the latest inflation data suggests slower progress in bringing inflation down toward our 2% target. Did you see that page of all the Fed speakers this week?
I know.
It looks like, you know, those maps of the presidents, like the 50 presidents that you used to have, that would be your placemat at dinner, and you'd have to, like, you know, memorize them.
Well, I don't know about dinner. Is that what you had to do?
Well, I don't want to talk about it.
Scarred. Coming up next in the second hour of Bloomberg Surveillance, Katie Kaminsky of Alpha Simplex, Mark McCormick at TD Securities, Bloomberg's Michael Shepard, and Qualcomm CEO Cristiano Amon. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Let me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg, context changes everything.
the overall market is still okay. I think the economy is still okay.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
The longer that these policy rates stay elevated, the more that they're going to bite into the economy.
The Fed is locked and loaded, so if there is a meaningful slowdown in growth, I think they're going to cut rates.
A market that was pricing in 7 rate cuts a little over a month ago might be looking at like none to 1.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Jim Bianco of Bianco Research absolutely nailing it. The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market negative by 0.3% on the S&P 500. Total capitulation. Started the year pricing 6 to 7 interest rate cuts for 2024. The dot plot at the Federal Reserve implies something closer to 3. We've come all the way down, Lisa, to the Federal Reserve.
What's fascinating is that even though you've gotten capitulation in the bond market, there's been no change in the stock market except up. If we do eke out a gain this week, it will be, I believe, the 16th out of 18 weeks of gains, which is the first time that's happened, going back something like until the 1970s. So you start looking at this, when are stocks going to wake up to whatever bonds seem to be, I don't know, realizing?
Jim nailed it, you nailed it too. It's not just about how quickly this spread closed. It took less than 2 months. It's not just about that. It's what didn't happen. Stocks are elevated, they're close to all-time highs. Credit spreads are at multi-year tights. And we're starting to see, Anne-Marie, consumer confidence pick up again. You saw that in the data again just yesterday.
Yeah, consumer confidence picking up slightly, although yesterday we did see some concern in the data in terms of how people are feeling about their own financial situation, their family's financial situation, and the labor market. And Dana Peterson, who was on the show yesterday but came out in the statement after, said they are more concerned about the labor market situation and the U.S. political environment. I think you'll see a lot of that as we head into November. And also, Constance Hunter hit on this. She said intentions for hiring are falling, intentions for firing are rising. And if you start to see consumers feeling concerned about the labor market, that means they're not going to spend as much. That's a big problem for this administration, which loves to say that unemployment has been under 4% for 2 years.
Payrolls 2 Fridays away. Let's put it like this. We often say this on this program, the most important payrolls report since the last one until the next one. But this one, I'm going to say it, this one really is. Because for a lot of people, the January data, how much weight do we put on it? Can we ignore it? Is it out of line with the trend over the last 6 months or so? The February data, if you get a repeat of January, we double down and reinforce what we heard at the start of this year, then you've got a very different conversation that starts to emerge about where we're going with Fed policy.
But then would stocks sell off? I mean, here's the question. Would that just still be a black hole in the bond market, leave just completely in isolation of everything in the equity market? Because as you said earlier this morning, that with the highest quarterly beat rate for some of the earnings on the S&P 500 going back to 2021, you start talking about that. I mean, if they're cutting people, maybe they're saving costs and their actually margins are going up. I mean, Bumble overnight cutting a number of staff.
I just want to understand this, just this one question. How many months like January do you need to reintroduce a conversation about more hikes at the Fed and at least inject some doubt into the committee that they aren't sufficiently restrictive, that they haven't done enough?
You know, it's a great question because especially without inflation picking up much more materially, I don't think it really reintroduces that question at all. If you start to get the ongoing hot prints and PCE, core PCE comes in tomorrow, hotter than expected also, which it probably will based on PPI and CPI, do you start having more of a conversation about a reheating? I don't know. This is not a Fed committee that wants to raise rates further.
It's just a thought exercise. Just trying to think about, you know, from a Bramo perspective, what it would take to generate the most pain. What would be more interesting to discuss, cuts into a general election or hikes into a general election?
Agreed. It would be much more interesting to talk about hikes into a general election, but I just don't think it's going to happen. I do think, though, that we're going to be talking about when is this going to bite in a more material way? And if it's not, is this the neutral rate? Are we at it? And that's sort of going to be this sort of big question at a time where the dynamism just seems to keep on dynaming.
Hikes into November would be terrible for the president. And he's actually said, I think the Fed has done enough. Remember last fall, he said, I think the Fed has done enough. They don't need to hike anymore.
Yeah.
But I do wonder if Jay Powell came out too soon on that 60 Minutes interview. It felt like he was trying to shore up the American people, their confidence on why he needs to cut rates. This isn't political. The data is showing us we are going to have this potential soft landing. Did he have that interview too soon if cuts are going to be pushed down the line?
Was he dynamic as well? What's dynamic? What's that word? Equity futures right now, we'll leave that there.
Thanks.
Equities right now down a third of 1% on the S&P. Love it. Yields down 2 basis points on a 10-year, 428.36. In foreign exchange, dollar stronger today against the Volcker G10, the euro 108.17. Coming up on the program this hour, Katie Kaminski of Alpha Simplex on why short signals in bonds are building. Cristiano Amon, CEO of Qualcomm, on the company's latest advancements in AI, and Mark McCormick at TD Securities on why he's bearish the US dollar. We begin with our top story this hour. Bond traders aligning with the Federal Reserve, now pricing in 3 rate cuts this year after looking for as many as 6 or 7 just last month. Katie Kaminski of Alpha Simplex writing this: short signals in bonds continue to grow as the fixed income markets price in the potential for stickier inflation data continuing and further delays in rate cuts. Katie, I'm pleased to say, joined us right now. Katie, we've all got the same question around the table. Have you turned short treasuries all over again?
Yes.
You've got to tell us why.
Well, if you look at what happened, really what's happened in the bond market is it looks like the market got ahead of itself. It said, okay, this is over. Let's throw in the towel. Rates are going to go lower. Time to buy yields. And what's really happened is we're not there yet. And thus, we've seen a very strong movement in yields upward again, which is very consistent with this idea that the market went too far and got too excited. And we've come back to a short positioning in fixed income because those moves have been pretty strong. And we're still trying to figure out what is the equilibrium rate in that environment for higher for longer.
Katie, can we draw a distinction between the conversation for the front end of the curve and the longer end of the curve? I think Barclays is asking the right question here, just with regards to what would stop yields going much higher from here. I think we've got to ask the question, how much more reason can you price out at the front end of the curve? We've gone from 4.1% at the lows of last month through 470 this month. How much juice is left to squeeze at the front end of the curve, Katie? Is the opportunity further out?
I think the opportunity is probably a little further out in the sense that there's a lot more leeway on the long end of the curve, depending on investor demand and depending on supply and demand in the bond market. And I also think that there's really, the question you have to ask yourself is, if rates are higher for longer, what is that curve shape that makes sense? And if it is actually a state where yields need to be higher for longer, maybe we need a premium for longer term debt that has to be a little bit more desirable to get there.
Why do you say that bonds and stocks are sending divergent signals if stocks seem to be rallying in the heels of the stronger data that's also causing the sell-off in bonds?
Well, so I think the thing that's weird about that is that if you look at fixed income, usually it's been focused on inflation in the same direction as stocks. So we've seen stocks have been relatively resilient in the face of the fact that data is consistent with stickier inflation. And that suggests that, you know, the bond market is pricing in higher rates for longer finally now, but the stock market hasn't moved on that particular realization in the bond market. That's why this week is so interesting, because it's going to give us more data to see if the stock market actually reacts to an upside tick in inflation risk.
Where would we see it first? We've been talking about the Russell 2000, but then on some days it seems immune as well as people look for bargains. Is there another area that you think needs to be the first to fall in response to higher rates for longer?
Well, I think the Magnificent Seven and the sort of large tech stocks have really been the ballast. And so I think if you see some sort of wavering in that particular sector, that is going to have a big effect on confidence. And I think you're also going to have to watch other sectors, such as the commodity sector, as a leading indicator to that particular reaction. And I think that's why people have been very concerned about energies this month, because it is potentially something that could come on the radar for inputs to CPI and other economic data that people are watching.
Katie, can we just sit on the diminishing rate sensitivity of this equity market just for one beat longer? Do you think because of this, that it just opens the door to even higher yields? We were talking to Subhadra Rajappa of SocGen about this in the last week or so, the last few days, that ultimately Treasury sell-offs are usually self-limiting because they cause enough pain somewhere that the rally returns, the bid comes back. Katie, given the absence of pain over the last 2 months, off the back of a pretty big repricing at the front end of the curve, have we opened the door to much higher yields with that in mind?
Well, this is something that I think why this is a good question is few people are really willing to worry about that. And I think if we actually had a scenario where we had much higher yields, on the long end, that would be a situation where, you kind of lost the bond market in some sense. So I think people haven't really thought about that as a risk because they're assuming there's really no chance that we'll have hikes again. I think it is a low probability, but I think it's always good to consider sort of extreme scenarios like that, which would be sort of more difficult for the markets and would have a bigger impact on equities than what's going on now.
It's a great thought exercise. It's one we played with for a couple of minutes at the top of the hour. Let's play with it a little bit longer. How many months of January-like data would it take to reintroduce that? Just to inject a little bit of uncertainty around the Federal Reserve's conviction, confidence, conclusion that they are sufficiently restrictive. How many months of January would we need?
I think we'd need a lot of months. And the reason for this is if we remember how long it took to say that inflation was transitory and how long we waited to act on the upside, I think there's some asymmetry there in the sense that there is definitely less demand for that type of hiking cycle. We'd have to see some pretty extreme reversion in upside risk and inflation, and it'd have to persist and be dangerous enough to cause central bankers to react. And I think that's still a low probability event, but it's something you cannot ignore considering that inflation is a key driver of asset prices right now in the stock and bond markets.
In the meantime, just to finish where we began, Katie, what's the level at which you think that 10-year yields are fair value?
So that's a good question. I mean, remember we were at 5% last quarter of last year, and it seems like we're creeping towards a level about 4 or 5. I'm not really one that picks specific levels. We don't pick tops and bottoms in markets, but there's definitely momentum there for the U.S. 10-year to continue up a little bit more. And that exact level, we'll have to wait and see what the data shows.
The momentum has shifted and you are short again. Katie, it was great to catch up, to get your thoughts. Katie Kaminsky there of Alpha Simplex with another turn, another change. Your 10-year at the moment, 428 and down a couple of basis points. Oh, Davis Abimo, Bramo, just to give you a number, looking for 450 to 475. That's a sweet spot for him where the buying starts to return in a big way.
So it's not necessarily people saying 6, 7, or 8%.
Not that I've heard.
But that said, there is this feeling this economy can handle a much higher rate for a much longer period of time. And that's something I haven't seen a lot of people grapple with on the corporate side with respect to borrowing and certain business plans.
You know how this works. We work in 50 basis point increments. You get to like 475, then they worry about 525. Get to 525, you start worrying about 75 and maybe 6%.
It's always like when you tell someone to meet you at a certain time. It's always 10:30, 10:15, 10:45. Why not 10:32?
Something like that. That's how it works often. I don't know why.
That's just it.
Just is. Just is. They're never like, it's like the S&P 500 targets, 5,400.
Yeah, exactly. Never 5,403.
Yeah. Why not? I don't know. Let's get you an update on stories elsewhere this morning because it's sales, maybe marketing, I don't know. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Voters in Michigan are bringing the nation closer to a rematch between Biden and Trump. With 98% of the votes counted, President Biden won an 81.1%, while 13.3% voted uncommitted. Democrats have been trying to send the president a message, with detractors pushing for those uncommitted voters to protest Biden's handling of the Israel-Hamas war. Michigan is home to a large Arab American population. As for the Republican primary, former President Trump defeated Nikki Haley by a vote of 68.2% to Haley's 26.5%. The Kiwi is falling this morning after the Reserve Bank of New Zealand left interest rates unchanged and softened the threat of a rate hike. The unchanged policy rate was forecast by the majority of economists, but the bank said inflation expectations have declined, allowing them to take a more dovish stance. The central bank still doesn't forecast rate cuts until next year, with New Zealand's 4.7% inflation rate still well above 2%'s target. Breaking into America's top 1% is now getting harder. It takes a net worth of at least $5.8 million to join the group. That's almost 15% more than a year ago. That's according to research from Knight Frank. That figure still leaves the U.S. fourth in the world, with a greater net worth needed in Monaco, Luxembourg, and Switzerland. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, the race to join the AI rally.
This AI party, it's just getting started. This tidal wave of spend, it's coming to the rest of tech. And in our opinion, that's going to continue to fuel this tech bull market.
You know what tops look like? Top of the market, like kind of that. Like, like kind of.
Pink plaid.
He's promised me that when all is said and done and the rally is over, he'll dress in black, but we'll see. That's coming up next on the program. Not that, but you know what I mean. From New York, this is Bloomberg.
Britain's next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women.
Stocks a little lower. We're down 0.4% on the S&P 500. Yields a little lower as well. We're down 2 basis points on a 10-year. Katie Kaminsky, Alpha Simplex, with us just moments ago. She's short again, this bond market. The 10-year, 427.76. Under surveillance this morning, the race to join the AI rally.
This is really the earnings heard around the world, the most important earnings in many years. And it shows this AI party, it's just getting started in terms of relative to what we're seeing in terms of peak demand. And now this tidal wave of spend, it's coming to the rest of tech. And in our opinion, that's going to continue to fuel this tech bull market.
Here's the latest. NVIDIA's record surge driving others to chase this rally, among them Qualcomm, the company announcing a series of advancements as it works to integrate AI into computers and smartphones through its processors. Cristiano Amon, CEO of Qualcomm, joins us now from the Mobile World Congress in Barcelona. Cristiano, wonderful to catch up with you once again, sir, for the second time in 2024. We appreciate your time, sir. I just want to talk about where we are now and where you think this is going. Where we are now, the focus seems to be on large language models, big data centers, and NVIDIA. Talk to me about the next phase of this and ultimately where you and the team fit in.
Very good. Look, good talking to all of you. Yes, a lot of excitement here in Mobile World Congress. A lot of new phones being launched with Gen AI. And I think the answer to your question is we're in the very beginning of the cycle. But like everything in computing, you saw a lot of things starts in the data center, starts into the cloud, and then go to the distributed devices. And I think what we have seen happening in the cloud for the past couple of years and accelerating right now, we're just starting to see the beginning of that happen in the devices. A lot of new use cases. The Gen AI is developing on phones, on PCs, on cars, on industrial devices, and this alongside the cloud. The use cases are a little bit different, and it could create, hopefully, a new cycle that people want to buy an AI PC, an AI smartphone, and I think that's going to be good for the industry.
Cristiano, can you describe what the use case might be? Are we still in the process of discovery? Are we in a position where we're sitting here thinking, we know this could be big, we just don't know what it is?
Yes. No, this is good. You know, what is interesting is you're starting to see some use cases now being available commercially. Some of the devices they had launched, you see things like, for example, live translation. You can call somebody and you speak in English, they hear in a different language, they speak in a different language, you hear back in English, and you see those large language models doing translation in real time. Some interesting thing happening on Android with Circle to Search, how it's changing photography, and those are some of the consumer applications. There's a lot of other implications for productivity as well. One of the most interesting thing, and it shows the transformation of our company. Every year we'll come to Mobile World Congress and we talk about a new cellular modem. And yes, we did that. I think we announced the most advanced 5G modem. But the biggest announcement from Qualcomm as the show was an AI hub. And that gives you an idea of how fast this is evolving. We get 75 models. We have models from OpenAI. We have models from Meta. We have models in open source where there's audio, video, image. Those are available for developers. They can start writing an application, integrate the model to the app, and push to the app store of Android and starting commercializing those things with all of the Snapdragon devices. And that's showing that we're at the beginning of something very interesting here.
You mentioned Android. You didn't mention Apple. And I'm curious, they just announced that they're getting out of electric vehicles and they're going to invest more in artificial intelligence. Will Apple be a competitor or a client in your pathway to really adopt a greater AI focus in your chips?
Look, we have a relationship with Apple. We're very proud of it. We provide modems, the cellular modems to iPhones, but we don't have a relationship with Apple on the processor. They have their own processors. We really support the Android ecosystems. If you look at all the Android devices in America at the premium tier are supported by Qualcomm Snapdragon. And we have been working with Google and all of our partners and many other companies like Meta and Microsoft with the Copilot and others. They're providing some of those capabilities. I think this is transforming the industry, and we want everybody to join. I think more companies to join. I think more that we're going to see this transition to an AI phone. And it's really going to change how we think about utilizing our smartphones.
Cristiano, there's a question about the barrier to entry, especially with NVIDIA, and how long they can continue to have these profit margins. Understanding that this is a different type of AI technology, how high is the bar for sort of a barrier to entry to really be competitive in this space and dominate?
Look, a lot of respect for what NVIDIA is doing. If I look at NVIDIA valuation, I think it just provides an inspiration and tell other semiconductor companies like Qualcomm what's possible. The exciting thing is what NVIDIA is doing in the data center, when you started to run inference at the edge, for example, into your phone, into your computer, into your car, you need a different type of platform. That's the platform that is in the data center. You need a platform that it can do this all the time in a very efficient way, and that's the Qualcomm expertise. All the battery-powered devices, that is the area that we always had the best computing platform. So it creates an opportunity for us to replicate that model of AI growth in the edge. And I think the AI Hub that you saw with all of the models on the Qualcomm platform and a lot of developers gravitating to it, it's a great starting point. So we're excited about that, and it's an opportunity for all the semiconductor companies with advanced processor to grow with AI.
Well, how much is your new AI Hub just a replication, though, of NVIDIA's CUDA?
It was interesting. It's different, but I think some of the press articles actually said the Qualcomm AI Hub, they even referred to that's the CUDA for the edge. So I hope they're right. That would be great to be in that position.
This is a conversation about the future. Let's have a bit of a conversation about where we are right now. Can you talk to us about how healthy smartphone demand is at the moment and whether the developments that we've just discussed can influence upgrade cycles as soon as this year?
Look, that's a very important question, and I can tell you how we're thinking about it. We're working very hard on technology to create that. Where smartphones is right now, it's stable. I think smartphones had suffered, I think, in 2023 due to the macroeconomics. I think, people postponed buying a new device. It's a mature market. However, we have seen in the beginning of this year that the market has stabilized. And while we cannot predict when is the next cycle, what I can tell you right now with precision is AI is changing how we interact and how we use our phones. And if consumers feel that they need to have an AI phone, that will create this new growth momentum for the industry. We just can really precise the timing, but we're busy making sure developers can access the platform and develop those incredible new use cases.
I'm sure. Delicate question, sir, just to wrap up. It wasn't just macro, as you know, it was also geopolitics for the likes of Apple, clearly struggling with a return of a little bit of nationalism in China and some competition as well there too. Do you think you have to pick a country to be in right now, China or the United States, or do you think it's sustainable to say we can be in both markets?
Look, we get this question all the time, I think because of the geopolitics. Here's the simple answer. If you are a semiconductor company and you have a leadership position, your product is highly differentiated, you're not in the commodity business, not only are you going to have a big business in the United States, you're going to have a big business in Europe, but you're going to have a big business in China. It's just a function of GDP. So as the company has diversified and went into phones, into PCs, into automotive, we also saw that expanding our China business as well. We have now a strong position with the China EV market. So in one way, I think that we have seen our business grow in China regardless of geopolitics, and it has everything to do about having a leadership position.
Let's pick up this conversation closer to November if we can. Cristiano, appreciate it, sir. I've got to go to the commercial break. Thanks for being with us. Cristiano Amon there, the Qualcomm CEO from New York City this morning. Good morning. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Barclays has got a new price target, 5,300 on the S&P 500. It was 4,800. Had several upgrades over the last week, not just from Barclays, also from Goldman, UBS, just yesterday as well, the last couple of days, Piper Sandler. Equity futures this morning down about 1/3 on the S&P. On the Nasdaq, we're down 0.4. On the Russell, some underperformance for the small caps this morning. Early days, we're down about 0.8%. Lots to talk about in the bond market. Let's draw a distinction between the front end of the curve and the longer end of the curve. We'll sit on the 2-year just for a moment. 470 earlier this week. First close above that level this week for the first time this year. Last month, close to 4.1%. So we're talking about a 60 basis point repricing as we price out a lot of rate cuts and capitulate to the Fed's view of the world, implied by the dot plot. The longer end, a little bit more interesting. 428.16 on a 10-year, down 2 basis points on a session. Katie Kaminsky, Alpha Simplex, on the program with us, Lisa, 30 minutes ago, talking about why she is short the long end of the curve right now and why her view has changed in the last 2 months.
The economic data is challenging the idea that this restriction of the Federal Reserve is enough to get us back to the inflation regime that they're looking for. Because ultimately it's saying that the economic trajectory is still incredibly positive. So why isn't that getting priced into some sort of premium at the long end? And that's, I think, what she's challenging, especially given the momentum shift, where that sell-off has persisted, even though you have seen equities hold in.
And there's no pain. Resilience in the equity market, to your point, in the credit market, another point. The economic data just reinforced the Fed communications, which led to this moment and that repricing at the front end. Let's take all of that and push it through foreign exchange. Today, at least, against G10, the dollar stronger against absolutely everything, including the euro. The euro down to about 1.815. We're negative by, let's call it 1/4%, 1/3%. Our next guest in just a moment on why this maybe isn't the trade, on why they're short the US dollar. Look out for that in just a second. 108.15 on that currency pair. Under surveillance this morning, our top stories. Republican leaders confident they can reach a deal to avert a government shutdown. Speaking after a meeting with President Biden, Speaker Mike Johnson and Mitch McConnell saying they're optimistic despite remaining far apart on key issues ahead of Friday's deadline. The two sides' long-standing disagreement on aid for Ukraine and Israel, as well as the US-Mexico border, remain at the center of negotiations. Senate Majority Leader Chuck Schumer describing the talks as, quote, the most intense he's ever encountered. So this is what's amazing to me. It looks intense. It looks like there is some real division there, yet still there is this confidence that ultimately we come to an agreement, or maybe we kick the can down the road. Is that because now the Republicans believe, based on your reporting and the people we've spoken to, this is no longer the outcome they desire? They need to, for their own good, do something about it.
Well, when it comes to the shutdown, Americans don't want to see shutdowns, and largely historically, you've seen them actually blame Republicans. So it looks like what you see from Speaker Johnson, Punchbowl News reporting, he's just going to move the goalpost, kick the can down the road. March 8th and March 22nd become the new deadlines. What he needs to do in the next few days then is shore up the top line on these appropriation bills so they can get passed through. I still think there's going to be a lot of back and forth when it comes to these issues some of the hard right want in terms of policy writers. And then the most intense part, Jonathan, was less so about keeping the government open. Everyone pretty much agreed in that room we should keep the government open. It was about aid to Ukraine. And that's when we heard our guest earlier, Kim, talk about the fact that Bill Burns coming in was a big part of that to try to hammer home this point to Speaker Johnson about why the administration thinks it's critical.
And that's the politics. Let's squeeze in some earnings. TJX, just dropping across the Bloomberg, expects to buy $2 billion to $2.5 billion of stock in full year 2025. Expects to boost the dividend by 13%. That's the capital return program. Lisa, we can talk about the numbers, but we mentioned, I said it rather snarkily just the other day, if you can't get deals done, I mean, just sort of by yourself. Capital return seems to be the way forward.
And that's been, frankly, the way that a lot of different companies have felt the need to deploy their cash. But what's fascinating to me is that it's actually more expensive now to do any kind of financing in the bond market, and that's what's pushing people more to equities. I will say they also came in with lighter than expected comparative sales, and they expect that to continue going forward. So to me, that's fascinating because this caters to the middle income family or the lower income family a bit more than, say, the Macy's that's moving to Bloomingdale's. So we see that trend on the margins continue.
Yeah, you see it in the outlook for the first quarter comp sales, +2 to +3%. That's the range they're offering this morning. The estimate was positive 3.84%. Pick up on that story in just a moment. The stock is just about positive in the pre-market. I want to talk about tech and one firm in particular, Google. The CEO saying the failure of its AI-driven image generation feature is, quote, completely unacceptable. In an email to staff, the CEO of Alphabet, Sundar Pichai, addressing criticism after the company's Gemini depicted historically inaccurate scenes. In the memo, Pichai saying structural changes will be made to prevent further incidents, stressing the need to deliver unbiased and accurate information. Now, I wonder what he's alluding to here, Ramo.
I mean, I guess that there's a real issue here because is he countering it right now in terms of the reputational risk? Or does he have to really go deeper to say what went wrong with the processes, when they were aware of this, why they didn't slow this down, why he wasn't more aware of this, and really highlight exactly how they're adapting to the AI models that they've currently created? Essentially, this is saying that their data sets were projecting something that the end user didn't want to see.
I think we have to draw a distinction between a regrettable mistake and an accident. Making an accident would imply they weren't aware that this wasn't working quite the way they thought it would be. A regrettable mistake is it works exactly the way they thought it would. It rolled out, the pushback was severe, and now they regret it. It's a regrettable mistake. But was it truly an accident? And the structural structural changes that the CEO is alluding to there, that implies that maybe this wasn't, and that's a big problem.
It wasn't in that they were trying to offset implicit biases in their data sets, and maybe it went too far. The issue that I think that's a bigger issue is, how do you deal with the fact that people are biased? And they put that data in, and that's going to generate biases. So then you're going to have biases that get entrenched in social norms. This is the difficulty. So how do you, as a content provider, a content search engine, how do you offset that? What are the right parameters for that? And who is in charge of that? These are all very big questions that we haven't established.
Two things. Can you put the genie back in the bottle, though? Everyone knows they came out with it, as Nate Silver was saying, prime time, when it wasn't ready for prime time. And then what is going to be the response in Washington, D.C.? Yet again, J.D. Vance, yesterday at a tech conference, partially hosted by Bloomberg, called for saying it's long past time Google needs to be broken up. And they have issues with what you're talking about, Jonathan, this underlying, what some of these Republicans would call underlying bias on the left when it comes to some of these tech companies.
I'm going to sound like a free market libertarian. Excuse me just for a moment, if I sound like a free market libertarian. Not that there's anything wrong with that, necessarily. Lisa, you said it the other day, and I think you nailed it. We can't rely on the regulator to do anything about this. They're slow. You've got some people in this world begging for the regulator to step in. I don't know if we could rely on them, even if they were up to date on all of this stuff. The market's spoken. They've rolled this out, the consumers pushed back aggressively, and they've had to change course. And it's not for the first time we've seen something like this. Can we keep relying on the market to do the regulator's job for them?
To build on that, is this actually things working right? That people did push back and then they're reassessing. And on some level, isn't this the preferred method when you still have the intellectual creativity to create some of these models that will be the future?
For now, at least, let's leave that story there. We're counting down to key economic data a little under an hour away. US GDP and core PCE numbers coming out at 8:30 Eastern time. After that, we'll hear from a trio of Fed speakers, Bostic, Collins and Williams, all speaking later on today. This is bond traders pull back on rate cut bets, now expecting the Fed to cut 3 times this year, having previously expected as many as 6 or 7. We can talk about what this means for foreign exchange. Mark McCormick of TD remains bearish on the US dollar. Here's the quote from him. The clear shift is in the direction of a better global growth engine. We pushed back on the dollar rally in October, underscoring that the US exceptionalism theme was waning. Global growth, not just the US, is improving, creating tailwinds for global equities, a weaker dollar, and outperformance of cyclical assets. Mark McCormick is with us now for more. Mark, let's get into it. Regime change. That's what you think.
Absolutely.
Walk us through what's changed.
So in the context of the FX market, there's been a dramatic regime change. We went from 2 years of focusing on a couple of factors that relate to all the things that are happening around the world. We had carry outperform, which we had countries in emerging markets that have higher yields. Those currencies outperformed, which was quite interesting in itself because this came through a Fed tightening cycle. The other side of it was in terms of trade, which is commodity momentum. So what we've been dealing with for 2 years in FX was G10 inflation, which was a dollar trade, carry, which was a dollar trade in G10, and then terms of trade, which was generally more global. So I think what we've seen in the last 6 months since the bear steepening of the US curve and the breaking of risk appetite through the summer, what we've seen is markets are now shifting a little bit more towards risk. But what I think what we're seeing is the regime is changing. We don't know what's on the other side. There's so many conversations we have with clients is the world going into recession? Are we going to have high inflation? Or are we going to see disinflation? So what we're seeing now and what I think is really interesting is that G10 itself in the world is pivoting more towards growth. We're carrying, what we see in our models is less focus on inflation. So if inflation's going up, you don't want to buy the currency anymore. What we're seeing is that growth is being upgraded largely because what the market cares about has changed in the last 6 months.
Well, let's get to the menu in G10. We'll go through some numbers. So sterling, 126, the euro, 108, dollar yen, 150-ish.
Yes.
Where do you want to play this story? Through what?
Yeah, so I think you want to play through a mix of G10 and emerging markets, and that's what's interesting about FX, because what we're seeing is now in the way that we analyze the markets, we're seeing G10 and emerging markets participating at the same time to basically collaborate against the dollar. So if you think about what's high quality in emerging markets, you've got India, you've got Mexico, you've got Brazil, you've got Colombia. So you've got the carry story, and you've got some high quality growth story. But I think India is the key thing you want to be looking at. Another thing that we really like is Korea. Korea is correlated to the global growth story, which this is where I think everyone's been wrong. Everyone's been focused only on U.S. exceptionalism. If you look at leading indicators, nowcast, data surprises, data trends, all these things in Europe and in Asia, everything is participating at the same time. So last year we went through a wave of US looks great, China and Europe are underperforming. At one point, China and Europe look great, the US is underperforming. What we're seeing for the first time is all three regions are firing in the same direction. And that is positive for global growth dynamics, it's positive for equities. So that's good for sterling, it's good for euro. I don't think euro is the best way to trade this. And the yen is also more of a BOJ feature. So the way that we like playing the G10 is you're selling the Swiss versus the yen. Because the SMB's done, BOJ's ready to go. I think there's market spending way too much time listening to what the BOJ says because they are never going to spoon feed you. They are always going to surprise. And we have the wage negotiations coming up, and then following that, we have a BOJ meeting, which to me is very, very live.
As you're talking, I'm thinking the biggest wild card in all of this is energy prices, because ultimately some of these nations are commodity importers, and a lot of these areas have benefited tremendously in terms of profitability from surprisingly low oil costs and other commodities. So how does that play into your call, and how do you understand that?
Yeah, the interesting thing is that we don't see as much volatility in commodities right now because a lot of that stuff is settled down. So the interesting part is there was divergence amongst commodities. So agriculture, base metals, energy all did wildly different things over the last 2 years. So if you thought about which country benefited the most from the environment we were in the last year and a half, it was Mexico. Strong US growth, high energy prices, high yields. It was, foreign direct investment, the rekindling of the U.S. supply chain back in North America, super positive for Mexico. I think one of the things you want to look at is that commodity factor story is not working anymore. So that's what we're seeing is the correlations are changing, and that terms of trade factor, the Sharpe ratio has gone from 2 years generating portfolio performance over 2, coming down to over the last 3 to 6 months, it's negative. So this is one of the things that's super important about FX. It's a complex system. The inner workings are always changing, and you're getting a signal coming from new things. You should be focused on growth. And this is the tailwind that comes from the drop in commodities. This is where G10 looks good. This is where Korea looks good. Korea is a major importer. So now that the terms of trade shock has reversed, you actually want to start scaling into some of those countries. Like we played long Swedish krona for a little while, which is a good way to participate in that. If you look at sterling, it should benefit again from fiscal stimulus and also from the reversal in terms of trade shock. And so should Korea.
You mentioned Mexico. That was a huge trade leading up to Trump's inauguration, and then it peaked actually on his inauguration. Do you think people will take a look at that trade again leading up to the November election?
Yeah, this is probably one of the most complicated questions we get because Mexico and China, there's, you have an analog of one sample and you have the previous election, then you overlay it to this one. And I think it's going to be very challenging because the dynamics of the macro world are just so much different than when they were in 2016. But Mexico is very interesting because right now, all the things that we look at from macroeconomic perspective still tells you to be long the peso. The one issue is that it's overvalued. So coming into the election, I think the way the markets are going to trade this is we know the Fed's going to cut. We believe they're going to cut in May. U.S. growth is still doing okay, but it's slowing, but it's not cratering. So the remittances, the capital flow story, all those things are positive for Mexico. I think everything will change once the conventions come, once we know who the two, the Democratic and Republican leaders are. We know our baseline, believe it's Trump and Biden, but we need to get to the conventions, I think, to actually trade that. And so I think what's going to happen is the peso is going to have a premium built into it. Valuations are going to matter, positioning is going to matter, and the way that we've been aligning this for clients is we say you should look, what you should do is sell the peso versus Brazilian real, because Brazil is more correlated with China. All the indicators we're tracking on China are coming back. Equity flows are starting to stabilize, and if you build in that risk premium around the uncertainty of Trump, the peso will underperform relative to a counterpart like Brazil.
Matt McCormick, thank you, sir. Sounded very confident until we started talking about politics, and that thing's got a little bit shaky. We'll talk more about that in just a moment. Matt McCormick, thank you, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Lawyers for FTX co-founder Sam Bankman-Fried have proposed he serve no more than 6.5 years in prison and pay no financial penalty for the fraud that brought down the crypto exchange. Bankman-Fried is facing a sentence as long as 20 years for the most serious charges. A court filing cites Bankman-Fried's charitable work and letters from psychiatrists, including an autism expert. Prosecutors have until March 15th to respond. That's before his March 28th sentencing deadline. The funeral for Alexei Navalny will be held in Moscow on Friday, according to his spokeswoman. The Russian opposition leader died in an Arctic prison camp earlier this month, with his spokeswoman previously accusing authorities of trying to interfere with the activist's burial. The funeral will take place a day after Vladimir Putin gives his annual address. A series of wildfires have ravaged the Texas Panhandle. Governor Greg Abbott has issued a disaster declaration for 60 counties. Residents have been ordered to evacuate or shelter in place, and a nuclear weapons facility has been forced to shut down. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, regulators cracking down.
This is how the giants see their way to improve profits. This is not a time for the FTC to say, sure, go ahead and merge.
More on that conversation up next. Live from New York, this is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
From New York City, equity futures negative here, 1/3% on the S&P 500. Yields a little lower. We're down 2 basis points on a 10-year, 428.36. Under surveillance this morning, regulators cracking down.
This is how the giants see their way to improve profits. They're looking at ways to reduce competition. And I got to say right now, particularly in the grocery business, where we've actually seen margins increase dramatically, both for the individual items you buy and at the stores. This is not a time for the FTC to say, sure, go ahead and merge.
Here's the latest this morning. Senator Warren urging the FTC to block Kroger's $24.6 billion acquisition of Albertsons. This as scrutiny mounts over acquisitions, with the DOJ initiating an antitrust investigation into United Health, the largest U.S. health insurer, according to people familiar with the matter. Bloomberg's Michael Shepard joins us now from D.C. for more. Shep, can we start with United Health? What are the team learning down in Washington, D.C., based on our reporting? What's happening here?
Well, what we're seeing is that United Health is the latest company to face scrutiny from the Justice Department over possible antitrust violations. The Justice Department, together with its counterparts at the Federal Trade Commission, together they police competition and market concentration enforcement across the nation. They've grown increasingly concerned across a range of industries, and healthcare certainly is one of them. With consumer prices ultimately and consumer access to healthcare as well, the real issues at stake here. And we'll be learning a lot more about this probe as it unfolds and what steps the DOJ may ultimately seek as remedies if it finds something truly amiss.
So we have grocery chains that we do know that regulators, a lot of Democrats are not happy with at the moment in terms of making one big conglomerate. They're going after United Health, the biggest insurer in the United States. And also, we heard from not just Senator Warren yesterday, but also J.D. Vance about tech. What's their issue right now with the tech industry?
Well, the tech industry is breaking down on a couple of different fronts for each of them. They appeared at a Bloomberg conference here in our Washington office yesterday before Senator Warren's appearance here on Bloomberg Television, and they are taking aim at the market clout of giants like Google, Microsoft, and Amazon. And in particular, what they're concerned about is the degree to which this may squeeze out smaller competitors. For J.D. Vance, the question is a little bit more on the free speech side. He is worried the conservative voices may be drowned out. For Elizabeth Warren, during her remarks at this event, she was focused on what these cloud providers may be doing in the area of artificial intelligence. And that matters because AI is such an important and promising frontier for big tech companies. And it's something that they have been trying to develop as an advantage going forward in the marketplace. For Senator Warren, though, she sees that as a risk. Her fear is that if these companies gain too much control and do not have restrictions on their use and development of the technology underpinning AI, the so-called large language learning models, what happens? That will crowd out smaller competitors, and it will ultimately have an effect on consumers and maybe on the marketplace as we see going forward.
It was another day of interesting bedfellows then, because Senator Vance also, in this appearance, said he likes Lena Khan, thinks it's one individual in the Biden administration he actually gives high remarks. Given the fact that you do see someone like Senator Warren and Senator Vance, Senator Warren and Senator Hawley lining up on some of these issues, could Congress move on any of this?
You know, it's a great question, Anne-Marie, and it's something we're going to be looking at and reporting on, because when you talk about strange bedfellows, you don't see it as often these days on Capitol Hill, where the political divisions run so deep. Yet between the two parties, there is occasionally a common thread of economic populism. And this is where you see somebody like J.D. Vance and someone like Elizabeth Warren actually finding a little bit of common cause as they look to some of the giants in the marketplace, not only in the area of grocery stores, in the area of technology, but we also mentioned healthcare too. All of these issues are what matter to their constituents, and this is something where you could see them coming together. We'll have to track it going forward, because also right now on Capitol Hill, we're seeing them have such difficulty getting even the basic things like a spending bill completed in time to avert a government shutdown.
Well said. Very true. Michael Shepard down in Washington, D.C. Michael, always enjoy it. Good to catch up as always. Mark McCormick at TD Securities back with us. Mark, let's talk about the politics. You talked about when this gets real. You said it gets real after the conventions. We have to confront that we end up with President Biden versus former President Donald Trump. Can we talk about the spread between perception and reality? And I'll set up perception and you can give me the reality. The perception is the Republican Party traditionally pro-business, that a former President Donald Trump will come in and be business-friendly. Can you talk to us about the reality based on the conversation we've just had, just how business-friendly this Republican Party in this iteration may well be this year?
Well, I think a big part of it will come back to the way it works from a top-down perspective on monetary and fiscal policy. I think one of the things that's clear is whether it's Trump or whether it's Biden, both governments are going to spend. And the spending, I think, is one of the things that when we gloss over whether or not this is good or bad for the market or for currencies, the dollar in particular, I think one of the things that worries me is everyone's glossing over the fact that the U.S. fiscal deficit pre-COVID versus where it's going and the amount of bond supply that's coming is not great for the world's reserve currency. I think the other side of it is that whether or not, again, if we take the baseline of where the Republicans, it's potentially business friendly for the U.S. It's maybe better for small businesses. Maybe it's better for the domestic agenda in the U.S. economy, but it's not great for the global economy. And I think one of the things that we're seeing is we're moving, and this has been happening for at least 10 years, we're moving into a fractured, multidimensional world where it's Americas, Europe, and Asia. And I think when you think about the prospects around how this works with the markets and how these things shake out, the geopolitics is one where blocks are trading with blocks. And so whether or not, again, the agenda will be good for certain sectors of the U.S. economy or certain equity markets from a macro perspective, I think any fracturing of the global system is marginally not great for the dollar, because the dollar is the hegemonic power that unifies that global system. So I think those are the things that we're looking at from an FX perspective. Again, rather just being like, last time Trump won, dollar rally because U.S. looked great. I think the context is so much different this time.
It was interesting. I remember when Kashgari talked about the deficit, and one thing he pointed out, Lisa, is that, yes, the deficit might be an issue, and yes, yields have repriced, but the dollar didn't sell off in that moment. And I think that was a really, really important point. Whether that changes this year into next year, if this deficit gets bigger, if we push out those tax cuts again, I think that's going to be one to watch.
Especially given some of the concerns about the reserve status, and just especially with Russia. You think about Janet Yellen's recent comments about what's going to happen with Russia. How much does that really change the dial in any way for the broader world versus just a Russia issue? TBD.
Hey, Mark, it was good to see you.
Thanks for having me.
TBD, we'll talk about it more in the future. Mark McCormick there of TD Securities. Coming up next on this program, in the third hour of Bloomberg Surveillance, Jack Caffrey of JP Morgan Asset Management, Bloomberg's Ed Ludlow, and Greg Dacko of EY. All of that still to come from New York City. Equity futures off session lows. We're negative 0.4%. Yields a little bit lower, down negative 2 basis points on a 10-year, 428.55 from New York. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife.
You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses.
Who dug this up? What are y'all in trouble?
Wow.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
The overall market is still okay. I think the economy is still okay.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
The longer that these policy rates stay elevated, the more that they're going to bite into the economy.
The Fed is locked and loaded, so if there is a meaningful slowdown in growth, I think they're going to cut rates.
A market that was pricing in 7 rate cuts a little over a month ago might be looking at like none to 1.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market is negative 0.4% on the S&P 500. Price for perfection, they said, in 1 week. 4 upgrades. We've heard from the likes of Goldman. Then it was UBS. Piper Sandler, Barclays going from 4,800, Lisa, to 5,300. Here's the quote. The U.S. economy continues to defy rates headwinds in 2024. Mega cap tech continues to defy even the most bullish earnings targets.
Are we now pricing to nirvana at a time where people are expecting artificial intelligence to transform the world? You are seeing more division within those stocks. We've been talking about it, though, all morning. It's not just a pipe dream. It's actually the earnings that have been coming in stronger than expected. So how do you pair this with the normal dose of skepticism that we all like to throw on things and call them bubbles and such? It's a difficult nut to crack at a time where a lot of these companies are actually doing pretty well.
And some of these companies, which we consider to be dominant in their own space, are playing catch up. And one of those is Apple. Let's talk about this transition. It's not just what they're leaning away from. It's what they're leaning into. Goodbye EVs, hello AI.
And it really highlights just how much the world has shifted, where you've had electric vehicles really become cars rather than a hope and dream of some sort of new reality and home for everybody. And then you have artificial intelligence, which is just exploding in every facet of every company. So my question is, how are they going to compete? Where are they going to catch up? And Apple, can they play the same playbook where they basically perfect it? They're late, but they do it better than everybody else.
Yeah, absolutely. When it comes to the EV game, looking at what Apple wanted to do, I think the biggest winner of sigh of relief had to be Tesla. And Elon Musk's tweet was great. It was like, thank you so much, and I'm smoking a cigarette. But when it comes to actual EVs, his biggest challenger is going to be China. But the entire EV market, whether it's GM in Michigan, whether it's Mercedes in Germany, they're all talking about the fact that the demand is just not there. And then Apple wanted to make something that was a massive price point of $100,000. But all those individuals working on that car, a lot of them were AI tacticians. So they're set up for when they move into the next phase.
That car, 100K, did not have the margins that they want. And to your point, this isn't going to be, based on what we understand now, to be that high margin luxury business that Apple thought they could be a part of just a few years ago. If you're not Ferrari, and you're not Ferrari, you're going to have a difficulty, you're going to have a problem. And I was asking Pierre Ferragu, and this is where I'm going, this is where my mind's going at the moment, if you want to know where my mind's going on EVs. If the market's just going to descend into this sort of quasi-sponsored, state-sponsored national champion, and who that is in the United States, yet to be decided. Is it going to be 2, 3? I don't know. But the war's going to come up regionally, in Europe, in the United States. China's going to try and compete. They are competing. Are they going to be allowed to compete in these countries? That's a big question for me.
Right now, all I can say is it's not fun to be a car maker. Even Elon Musk, sure, he might be smoking a cigarette emoji, but we are looking at a situation where he wants to call himself a tech company too, because it's hard to make cars.
Really hard, particularly with these margins, and the margins are going in the wrong direction. Equities right now on the S&P 500, negative here by 0.4%. Here's a snapshot of the price action for you. When the bond market yields lower by 2 basis points, 428.36. Talked a lot about that dollar strength through the bulk, if not all of G10 today. 108.09 against the euro. Dollar stronger, euro weaker. That currency pair negative a third of 1%. Coming up this hour, JP Morgan's Jack Caffrey on why he sees market leadership changing in the equity market. Bloomberg's Ed Ludlow on Apple's stalled EV plans, and Greg of EY reacting to breaking GDP and consumption data about 25 minutes away. We begin with this hour with our top story. Equities treading water after climbing to freshly minted all-time highs. JP Morgan's Jack Caffrey pushing back on the narrative that stocks are riskier because we have seen a narrow market, saying this: yes, some considerable heavy lifting has been done by technology and communication stocks. The most impressive relative sector gains of late have actually been from healthcare, industrials and financials. Perhaps the important takeaway is times and leadership are a-changing. Jack's with us right now to talk about it. Jack, good morning to you.
Good morning.
Are we seeing that leadership shift beneath the surface, you think, right now?
I think you certainly do. I think, you know,
I'm going to get in trouble because I'm going to be technical now rather than the fundamentals that I was trained in. But if you look at, say, relative strength, healthcare is in leadership, industrials in second place, financials in third, and technology is in fifth or sixth. So yes, we can sit there and talk about the Magnificent Seven, but we are spending a lot of money on getting skinnier. Despite me asking, I still can't get 40 pounds taken off when I get my face put on before joining you.
Bramo's been talking about GLP-1s and getting skinny for a while.
Okay, well, hold on a second.
Europe. By Europe is Bramo's trade.
From the stocks.
Granola.
From the stocks perspective.
No,
I'm not getting personal.
coming every day.
Okay.
But even within healthcare, it's not just a GLP-1 story.
Forgive me, Jack. Let's get up the single.
Okay.
We're not talking about people's weight around this table, okay? I was talking about stocks.
I know.
Jack,
All right,
continue.
carry on.
Go.
Yeah, I'm not touching weight jokes because, with the exception of my own, I want to keep having a job. So you see healthcare working, but you look through and then you see names such as Stryker doing very well. That is definitely not a weight loss trade. Within that, it's actually people are old, they're needing to get things done, they need to get fixed. You're seeing like major banks screening as overbought in the short term. And sort of interesting because you would have thought banks would need a steeper yield curve. We're seemingly getting our conditions of almost a flatter yield curve. Even when you take out the idea of 20, 75, 80 basis points of rate cuts, that still doesn't get you a positively sloped 2-year, 10-year yield curve. So, the fact that financials are trading off of a little bit more fee activity, a little bit more trading activity, maybe some deal activity coming back to life and not just being anchored off of what net interest margins wind up doing, I think it speaks to a healthier economy and that we come back to this idea that, not to say that the recession will not happen, because it will. It's the function of the timing seems to be more out there than people wanted to think 12 months ago, 6 months ago, 3 months ago, or to some extent what the bond market still wants to discuss.
Fundamentals eventually. Let's build on that just a little bit. I've got two as well. Multiples versus earnings. Multiple expansion versus earnings. Where is the upside in this equity market coming from, do you think? Earnings versus multiples? I
think it has to come from earnings. At 20 plus times, valuations are not a good short-term timing tool, but once you start pushing 20 plus multiples on the S&P 500, you really start saying the heavy lifting has to be done by companies themselves rather than psychology. In that regard, the fact that earnings were positive in the first quarter, that earnings surprises were on the order of 7%, you wind up saying, like, the news is good. And to some extent, stocks shrug that off. The average stock was only up about 0.2% despite the size of the earnings gains. That all said, two of the Magnificent Seven managed to post, call it $480 billion in market cap increase, arguably within about 15 minutes of reporting results in the aftermarket. So those trades might have been 10,000 shares total that created that much market cap gains. But the reality is, like, stocks have been working.
Do you care about bonds? The fact that yields have gone up so dramatically, the fact that we're
I think that stocks have been able to look through that interest rate increase. I mean, the 10-year's gone from, 4% to 4.30 last night. I think speaks to the news has been good in the corporate sector. And I think fixed income is following the reality rather than leading. For most of my career, the fixed income market's right. It feels like fixed income has been on its back foot now for a year and a half in terms of trying to understand what's gone on. And I think, as an equity investor, that makes me happier.
Does that mean that you can ignore the Fed, or that you can basically park the idea of the changing Fed expectations and prioritize fundamentals and technicals about, earnings and what's leading?
I don't want to be Pollyanna, and I say that because if we look within, implied equity volatility, the VIX is at 13. So equity volatility has returned to levels we saw before COVID when nothing could go wrong. Implied yield volatility is 110, and that's at levels that are low relative to the last 2 years, but running two plus times what fixed income volatility was before COVID hit. So as an equity investor, if something bad happens, it's most likely going to be reflected in shifts in yields quickly, and then equities will probably be put on their back foot by bond yields spiking higher for some reason. Now, if yields fall, that probably fits into a narrative of the economy slowing, and then maybe we should probably be more concerned about those positive earnings expectations we all have. But right now, And of course, everything I say will be obviated at 8:30 when the PCE comes out. So let's be a little bit humble here in terms of my ability to prognosticate single data points after a significant digit.
That data 20 minutes away. So we've ignored the bond market. We've been captivated by two stock stories. You mentioned them, NVIDIA and Meta, with single day.
I didn't mention them, you did.
I did. You alluded to them. Single day market cap gains of more than $200 billion, which is just amazing. That's nuts. So you did suggest it. And then ultimately, we've ignored what's happened abroad, which is all-time highs in Germany, all-time highs in France, all-time highs in Japan. Can you talk to us about opportunities beyond the United States abroad?
Certainly the Japan story has been impressive and largely silent to, I think, most international investors, because it was really easy to spend the better part of my career saying, run a global portfolio underweight Japan. To the extent you've seen structural reform in Japan, that's impressive. To the extent you have companies that had as much as 40% of their balance sheet in cash, an asset that earns 0, and they could still generate returns on equity of 7, 8, 9% with nearly half your balance sheet doing nothing for you, it would suggest that there's actual profitability there. And in a world of maybe trying to friend-shore certain key technologies, Japan has a history of precision manufacturing. They understand these technologies. And if you can get over the fact that you might build a semiconductor fab in an active earthquake zone, maybe there should be some interesting capital spending decisions that wind up going there, and the government says, we'd like to be your friend.
It's a very good final point. We'll leave it there. Jack, thank you. It's good to see you. Really thoughtful, as always. Jack Caffrey there of JP Morgan. Stocks at the moment down about 1/3 of 1% on the S&P, negative by 0.4% on the S&P 500. Have you read Chip Wars? It's a fantastic book.
Yeah, it is a fantastic book.
It talks about where those plants are and where those plants probably shouldn't be.
Well, this is why Bank of America put on their top global risk for the year, citing a lot of data from the geopolitical world that the Magnificent Seven exposure to Taiwan is more than 90% when it comes to those chips. That's why I see this administration trying to build fabs in the United States, and also even TSMC moving to places like China, more friendly countries.
Massive issue. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Voters in Michigan are bringing the nation closer to a rematch between President Biden and former President Trump. With 98% of the vote counted, President Biden won with 81.1%, while 13.3% voted uncommitted. Democrats may have been trying to send the president a message, with detractors pushing for those uncommitted votes to protest Biden's handling of the Israel-Hamas war. Michigan is home to a large Arab American population. Now, as for the Republican primary, former President Trump defeated Nikki Haley by a vote of 68.2%. Haley's was 26.5%. U.S. mortgage applications have dropped for a 5th week. They're now nearing the lowest level since 1995. Now, according to the Mortgage Bankers Association, those applications fell last week by 4.5%. Mortgage rates for a 30-year fixed contract started below 7%, but now they're sitting at the highest mark of the year so far. Starbucks says it has agreed to meet with the main union representing its workers. The two sides are expected to build a framework for collective bargaining agreements. The company will also offer benefits and credit card tipping to those with Starbucks Union Workers United. Those perks were previously only offered to non-union shops. Starbucks has faced disputes with union organizers and the National Labor Relations Board since the first store voted to unionize in 2021. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, Apple slamming the brakes on its EV plans.
Apple has tried very hard, and they came to the conclusion they can't make like a sustainable and good business at doing cars.
That's coming up next, live from New York. This is Bloomberg.
Connection lost.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
The opening bound just around the corner. Going into it about an hour or so away. Hour 13, 14 minutes away. Equity futures negative 0.4% on the S&P. Yields are lower by a couple of basis points, 427.76. Some economic data about 13 minutes away. We'll break that down with Mike McKee and Greg Daco of EY in just a moment. Under surveillance this morning, Apple slamming the brakes on its EV plans.
Apple has tried very hard and they came to the conclusion they can't make like a sustainable and good business at doing cars. Tesla has been doing an extremely good job, has pushed like the bar very high, and now the Chinese are coming in, filling the void around Tesla, and the competitive game between Tesla and the Chinese is not going to leave much room for others to be successful, even if you're Apple.
Here's the latest. Apple ending.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I developed the all-in-one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
That are already out there, and I think a lot of people would say leave it to the specialists, in this case Tesla. But even if you look at it from the perspective of the autonomous technology providers, the LiDAR makers or the likes of Waymo, you know, there are notes out there this morning that say this stuff's really hard, and just because Apple is Apple, there's no guarantee that they would have been able to pull it off.
How much overlap, Ed, is there between the EV effort that's being shuttered and the AI effort that's being doubled down on?
Yeah, I mean, they're essentially the same thing. You know, what powers autonomous driving technology is on the training side, a neural network. It's just another word for large language model, essentially. You know, many of the disciplines and competencies are the same. You are training AI to interpret the world around you. And there was a really fantastic BNEF analysis out yesterday about the energy consumption of the future of autonomy. It's really hard to build a vehicle that can sustain itself on a journey through the battery and also power the compute needed to have advanced driving technology. So these are very similar competencies, and loads of people that I've met over the years in California, they might have worked at NVIDIA or Tesla in robotics or at another AI company and interviewed Apple for a position on the car team. And I can tell you that many I spoke to last night were glad they didn't take that job.
There's a real question here of when we're going to start seeing it in earnings, when we're going to start seeing it in new products. Yeah. Do you have any insight into what the timeline is?
Well, look, here's the thing, like, why would we see it in earnings? You know, we just talked about the idea that they're shifting what's left of the car team, many of them, to the generative AI effort. If you look at the reporting that Bloomberg's done, their AI efforts largely are developer focused. So Xcode is the platform that helps developers write code for iOS apps, and their generative AI work seems to be focused on helping developers make that process more efficient. That boosts the Apple Store ecosystem, but there's not necessarily an immediate or tangible read-through to the top line. I do think that there's a bit of pressure here. I think what's in common with the AI story and the car story is the reporting that Mark said that the board were looking at both. And I think the board looked at AI and said, start showing me some evidence that there's a product here. And they had the same conversation around cars, and the product wasn't there. So they said, okay, let's shut it down, shift the resources to the AI project. But it's still not clear, same as with the car, what is the consumer-facing generative AI tool here? And as I just explained, I think they're very much more focused on the developer ecosystem. And as Tim's reflected on the call, you know, they feel they've got a long-standing history of AI and machine learning. It's just not in the way that OpenAI or Microsoft are putting it to us right now.
Do you think that we can get enough clarity around use cases that we can develop a new iPhone this year that leads to enough appetite to get an aggressive upgrade cycle, one that's been absent over the last 12, 24 months?
Yeah, this is probably the multi-billion-dollar question. You know, the pitch from the chip makers, particularly Qualcomm, I think you had Cristiano on the show earlier, right, is that the next phase of this is us using generative AI tools on our phones, even if they're in airplane mode. So the phones need to be able to process the large language model locally without having the need to have it just immense compute power on the phone or a drain on data. But the phone isn't there yet, really. You know, Samsung has done some of it with their latest Galaxy localized AI. That is the question. I don't know, John, if you're an iPhone owner or a user. I am. You know, Siri is pretty underwhelming at the moment. And I think a lot of that, this is the frustration of the street and also of consumers. They're like, when are we going to get this all singing, all dancing AI in the iPhone, something more akin to what ChatGPT does, which you can get through an iOS app anyway. So it's going to be a little while, but that is the hope, that the next upgrade cycle is not 5G or 6G. It's the ability to interact with AI on your phone locally using its local compute power and without draining immense volumes of data.
And battery. Ed, thank you, sir.
And battery.
And battery. Ed Ludlow on the West Coast. Look out for Bloomberg Technology a little bit later this morning. About 3 hours away with Bloomberg's Caroline Hyde. Can you imagine? Never mind developing AI. You need a way better battery to deal with some of this stuff.
I know, you've got issues with batteries.
You think?
Yeah. I mean, how's that going with the old one?
Actually, you know what? It was tricky for a couple of weeks. It's settled down.
Okay.
So I haven't upgraded.
All right. I mean, it's true. The battery change is the real motivator for me to get a new phone. When I start to have about 2 minutes until it starts to die.
You upgraded, right?
Yeah, that's basically how it
Dan Ives has been talking about this massive upgrade cycle that's coming, right? Hasn't come. What's been amazing about it, of course, is that Apple carried on rallying, even though a lot of people were wrong about iPhone revenue growth. The big bulls I'm talking about here were wrong about it, and yet still they were right about the stock because the stock kept performing.
And because they've dominated in terms of just iPhones, just smartphone sales. I mean, the fact that iPhone and smartphone are sort of synonymous. To me, the fact that Galaxy is ahead on the AI front, or seems to be at least talking about it more earlier, does that change the dynamic in any way?
But on the AI front, on the surface, to Ed's point, what AI has been doing, what Apple's been doing with AI is on the developer side, to be able to make them work better and more sufficiently. Ed also brought up something very interesting. He said when it came to the board in the car, he said the car wasn't there. I actually argue the demand isn't there right now for the EVs in terms of how much money Apple wanted to just pour into them.
You can see that. It's been bad news after bad news for that industry over the last month or so. My temptation yesterday was to run away with the idea, let's talk about EVs, let's talk about EVs. I actually think for Apple, the biggest story here is Apple. It's not Tesla, it's not the Detroit 3, It's Apple trying to play catch up on AI and saying, you know what, this stuff here, we need you elsewhere.
To me, that is the story. It's the existential question facing so much of big tech and, frankly, the big winners. How do they adapt before they get, frankly, overwhelmed with other companies that have adapted better?
Alphabet as well, they dominated for a long, long time. There's some technology here that risks that position at the top of the pile that they've been at for much of the last decade. Multiple decades in the case of Alphabet. Coming up next on this program, breaking economic data, including US GDP, an update on that in just a moment. Mike McKee's going to break down the data for you. We'll have a look at the numbers, the price action, the market response to them, and we'll catch up with the EY chief economist, Greg Dacko, here to react to the economic data. Going into it, equity futures, negative 1/3% on the S&P 500. Yields just a little bit lower through the curve, the 2-year out to the 30-year. The 10-year is down 2 basis points at 4.28.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women.
Stocks on the S&P 500 negative here by 1/3% on the S&P, a little bit lower on the Nasdaq, down 0.5%, a little bit lower on the Russell. The small caps underperformed, down by 0.6%. Bit of economic data for you in just a moment. An update on GDP for the fourth quarter, on PCE as well. 24 hours away from the PCE core deflator, the Fed's preferred measure of inflation. That's coming up tomorrow morning. Yields on the bond market look like this. Coming into all of that, your 2-year yield is down 3 basis points. The 2-year 4.66 with a sprinkle of economic data data. Here's Mike McKee. Morning, Mike.
Good morning, John. We have the GDP update here. The first revision, 3.2% for the fourth quarter. That's down a tenth and a little bit below what analysts had expected. No change was expected from the 3.3% in the advanced number. This is interesting, though. Personal consumption went up 3%. It was 2.8% in the original release, and 2.7% was expected, so we got a little bit more personal consumption than we anticipated. And we do have an inflation reading in this. It doesn't get a lot of attention because the number we get on the PCE tomorrow will be the latest. This is fourth quarter annualized 3-month numbers, but 1.6%, that's up a tenth from the initial report of 1.5%, and 2.1% on core, also up a tick from the original. Look for more of the breakdown now. I don't know if there's any reaction to this, because it's kind of what we expected.
It's like the appetizer before the big one tomorrow. The main event is tomorrow morning when we get the PCE core deflator. Equities stacking up as follows, about an hour out from the opening bell. We're negative a third of 1% on the S&P. You can see on the NASDAQ there, basically unchanged from where we were before the data. Still negative 0.4%, down about 0.7 on the Russell. The small caps underperform, as I say. 2-year yields are still lower by a basis point or so, 468 on that particular maturity in the Treasury market. We're down about a basis point or two on a 10-year to 428.75. Euro against the dollar, basically where it was. Bit of dollar strength, 108.11 on that currency pair. We're negative about 0.3%. Mike, you do wonder what we can learn from the fourth quarter, what we can learn from January going into the data tomorrow morning.
Well, the fourth quarter numbers are basically going to tell us where we were, but a kind of a setup for the first quarter. We've seen some good numbers in terms of consumer spending so far. Basically all we have is January, but this tells us that we had a higher base going in, and more money was spent than we anticipated. Now I'm looking at non-residential fixed investment, and for 2023 comes in at the end of the fourth quarter at 2.4%. That's up from 1.9. So businesses and governments spent more money in the fourth quarter than we anticipated, which is interesting. We must have had, and I haven't gotten to that yet, a decline in inventories or something like that, which is what people are going to be watching. The price numbers, as I mentioned, are important tomorrow because they tell us what it was in January. And of course, we had that surprise with CPI. The numbers that we see for the fourth quarter are nice, but they're close to what the Fed wants, but they're not telling the Fed what it needs to know about where inflation is. We did get a couple of other numbers that will figure into GDP. For the first quarter, retail inventories up 0.5%, which is more than anticipated, down from 0.8 in the fourth quarter, or in December rather, and wholesale inventories were down a tenth compared to a 0.4 rise. So maybe they kind of offset each other, but they do show a little bit of a slowing in inventory builds so far. Again, only January numbers, but with the January numbers we have as of yesterday, Atlanta Fed GDP now was running about 3%.
And it's going to be the first time that you're seeing it run above 3% pretty consistently for a number of consecutive quarters going back several years. I'm just looking at this and thinking a lot of these surprises are in the same direction. Even though you want to say that January is messy and all this data doesn't matter until it matters, it's all trending with inflation not coming down as quickly as people thought. Is that giving concern to the 15 Fed speakers who are speaking today and tomorrow?
I don't know about concern. I mean, they have argued for a long time that it's going to be a bumpy ride. I do think that the strength of the economy has surprised them. They expected their rate increases to slow growth more than it has been. Some interesting conversations about that lately. Larry Summers and company wrote a paper that they put out yesterday on the NBER suggesting that people's attitudes are based on the fact that interest rates are high, but they're spending because they're not taking out loans. They're using what they already have. And John Authers today for Bloomberg suggests something similar, and that the difference between what people are paying and what people see the cost is contributing to concerns. And because the cost that they actually have to pay aren't really higher, companies are still spending. And so the economy keeps going, and that may be taking the Fed a little bit by surprise as they get ready to speak. But again, I go back to the fact that what they say this afternoon, all these Fed speakers today and tomorrow, will not matter all that much because Jay Powell speaks on Wednesday of next week at Humphrey Hawkins. And that's going to be the event where all the bond traders got to be sitting at their terminals and readjusting their thinking.
I can share the calendar with you on my Bloomberg terminal right now. The Fed speak over the next 3 days, today, tomorrow, Friday. Bostic, Collins, Williams, Bostic, Goolsby, Mester, Williams, Waller, Bostic, Daly. That's the lineup. It's kind of nuts, isn't it?
But that's the presidential placemat that you used to get, that you had to kind of memorize all the names. This is just, Fed version.
Just incredible. You're going to hear from all of those Fed officials to respond to the data we're going to get tomorrow morning. Greg Dacko's with us now, chief economist at EY, to weigh in on some of this. Greg, noise versus signal in January. How much of this was noise? How much of it is signal?
I think, unfortunately, we had a lot of noise in the January data. It's not just one direction. I think we had an inflation print both on the CPI and PPI front that were quite noisy. A lot of January reset in services sector prices, a lot of influence from residual seasonality, perhaps even some weighing issues in terms of the pass-through from December to January. So I would tend to take a bit of a step back from the January inflation data. The employment report was also very noisy, very strong, but very noisy. And the retail sales data, home starts data were on the weaker side, but also very noisy. So it's not just one direction. A lot of noise there. I think we have to take a little bit of a step back in terms of what's happening. The disinflationary momentum, in our opinion, is still very strong. We are seeing an economy that is robust, but it's non-inflationary. And the key reason why it's not inflationary is because productivity is picking up, and that, I think, has legs.
Are you suggesting it won't be repeated? Just the first part of your response, it won't be repeated in the February data?
I think there tends to be a bit of echo when you have movements that are that strong in one direction. So there may still be some echo in the February data, but I think we have to look at the next couple of months. And that's what some of the Fed speakers have been saying, Waller in particular. We have to look at the next couple of months of data before we make a decision as to whether to start loosening monetary policy. I think that's the better approach. Have more of a forward-looking approach. Think about the underlying drivers of inflation, which are the fact that we are seeing an environment where there is more price sensitivity, where companies are being a little bit more careful as to how much they price out, and where you are seeing that wage growth moderation, which is a key driver over the medium term of easing inflation.
We had Jim Bianco of Bianco Research on this week, and he was saying that maybe inflation's bottoming out here at about 3%, and we'll stay here, or we'll even go up higher. What gives you conviction that that's not the case at a time where people are actually getting real wages and they are going out and spending, albeit with maybe a little bit more discretion, but still spending?
They are still spending, but they're exercising more scrutiny as to how they spend. You'll probably see in tomorrow's report on consumer spending trends that there was a little bit of a pullback in real spending. So people are buying, but they're buying fewer goods, fewer services. They're paying that additional cost. That cost fatigue is very much part of the picture. But we're seeing a little bit more discretion in terms of spending. We're seeing a little bit more of that disinflationary pipeline on the housing front that will come to fruition. We're also seeing companies being more careful with how much cost they allow for wages. So wage growth compression is also very much part of the picture. Those are the type of disinflationary currents that have a lot of momentum and that can carry us through from 3% to 2%. I don't buy this idea that the last mile has to be the most difficult. There's no evidence of that.
I keep thinking about Bespoke Investment Group and this idea that they came out with the fact that we've seen the fastest pace of actually financial condition easing over the past 4 months, going back to only times of crisis, right? I mean, this has been an implied easing of financial conditions, unlike what we've seen since the 2020 pandemic. How does that work against the Fed's goal and the sort of last mile difficulty that you don't see as a difficulty, but many other people do?
I think the key question here is what the Fed is going to be doing, and market interpretation of what the Fed is going to be doing over the course of the next year has shifted quite dramatically. Just a few weeks ago, we had markets pricing in 6 rate cuts this year with the onset in March. Then there was that pushback from Powell, which led to a reevaluation of market pricing. That has helped ease financial conditions. But what did that come from? Data. And the data can switch quite rapidly, which in turn can have a rapid effect on financial conditions. And I wouldn't be surprised that over the course of the next few weeks, we see the reverse movement with all of a sudden weaker data surprising markets, leading to a repricing of more rate cuts and potentially even earlier than June. And that would shift the narrative once again. So you would have tightening financial conditions to which the Fed would probably want to react.
There's been a preoccupation amongst consumers with inflation. Yesterday, the conference board, though, said actually people are starting to worry about the job market now. Are you seeing cracks in the labor market?
We're not seeing cracks in the sense that there is a risk of a retrenchment in the labor market, but we are seeing a softening in terms of labor market momentum. We're seeing that job growth, if you exclude the December jobs report, which was very strong, we'll see what we get, the January jobs report, which was very strong, we'll see what we get in February. We're seeing a slowdown in terms of labor demand. We're seeing less diffusion in terms of job growth across sectors. We're seeing hours worked being pulled back. We're seeing the hiring rate at a low since 2014. So all of those are indicators that there is a softening in labor demand. No retrenchment. We're not seeing the type of rapid layoffs that occurred in prior recessions. That's because the value of talent is much higher than it was before. But we are seeing some signs of weaker labor demand.
I know you're economists, but if you were a bond strategist, I'd be hearing by the 2-year right now, wouldn't you?
100%.
The yield to the front end might have peaked.
And that potentially we could even get a rate cut before June, which is now very much against consensus.
Is that right?
We're still holding on to our call of a May Fed rate cut,
right.
but we think that the data will be the guiding factor in that call. There is certainly a lot of risk that the Fed waits a little bit longer. They've been burnt on the upside in terms of tightening too late. They're likely to err on the side of caution when balancing labor market risks and inflation.
So I know a lot of June guys that always write in their reports with the risk of it being pushed out. Are you a May guy with the risk of it being brought forward?
Not being brought forward.
Just one balance of risk, that's all, just around your call.
I think that the risks are more that it's pushed back to June rather than pushed earlier. I think March is out of the question.
Just trying to work out how dreadful this data might be. How much echo we get from January into February.
What kind of guy are you? I'm a May guy.
I'm a May guy with a bit of risk around the view. You know?
I'm a September guy.
It's a great chat at the bars, Bramo.
It's really, I'm going to try it.
I'm a May guy.
Mike McKee, final word, please. Lesson from this data, big takeaway.
Well, a couple of really interesting things in here. It was a big drop in inventories that caused the 0.1% drop in GDP, but real final sales to domestic purchasers go up 2.9% from 2.6%, which shows you the strength of the economy in the fourth quarter. And when you look under business investment, intellectual property gained quite a bit, 3.3% up from 2.1%. You wonder if that's AI. We don't have enough breakdown to know exactly. But if that's the kind of spending that we're talking about in that area, then what Greg said about productivity going up is going to come through.
Mike, Greg, this was great. Appreciate it. Thank you. Equities right now on the S&P down about 1/3 of 1%. Just a snapshot of what's happening elsewhere outside of equities. Your bond market picture looks like this in the Treasury market. A 2-year at the moment down a couple of basis points still, 468. On a 10-year down 2 basis points to about 428. And in foreign exchange, the euro still negative by 1/4%. The dollar pretty dominant against G10 through most of this morning. The euro against the dollar, 108.16. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, the price of Bitcoin has passed $60,000. It's happening for the first time in 2 years. The largest crypto has gained more than 40% so far this year. The surge was helped by that launch of those ETFs holding the coin. More than $6 billion have been attracted into the funds since they started trading on January 11th. Bitcoin hit an all-time high of nearly $69,000 in November of 2021. Breaking into America's top 1% is getting harder. It now takes a net worth of at least $5.8 million to join the wealthiest group. That's up almost 15% from a year ago, according to research from Knight Frank. That figure still leaves the U.S. the 4th in the world, with a greater net worth needed in Monaco, Luxembourg, and Switzerland. A series of wildfires have ravaged the Texas Panhandle. Governor Greg Abbott has issued a disaster declaration for 60 counties. Residents have been ordered to evacuate or shelter in place, and a nuclear weapons facility has been forced to shut down. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, Washington taking big business head on.
This argument has been used pretty much since the beginning of time in antitrust law. Oh, please, just let me get bigger so I can compete with the other giants.
That conversation coming up next.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City, equities right now negative 0.25% on the S&P 500. Yields a little lower. We're down 2 or 3 basis points. 427.57. Your opening bell about 43 minutes and 29 seconds away. Under surveillance this morning, Washington taking big business head on.
This argument has been used pretty much since the beginning of time in antitrust law. Oh, please, just let me get bigger so I can compete with the other giants. Do they improve profits by lowering costs? No, that's not where they're going. They're looking at ways to reduce competition.
Here's the latest today. Representatives from Apple meeting with the DOJ in an attempt to get ahead of an antitrust complaint. US regulators say the company imposed hardware and software limitations on iPhones and iPads in order to hold back competition. Bloomberg reporting a lawsuit from the Justice Department could be ready by the end of March. Bloomberg's Mandeep Singh joins us now for more. Mandeep, there's a lot of pushback against big tech, not just from Senator Warren, but from other parts of Washington, D.C. as well. Google is in the crosshairs of this, I think, over the last week too, because of the failure of Gemini as they've rolled that out, particularly around pictures and what's happened with their AI product. Mandeep, can you tell us, from your perspective, whether these companies will be trusted with this technology or whether we're about to see a more assertive regulator in Washington?
I mean, everyone realizes that these companies have too much power, and, you know, because of the concentration, they're drawing a lot of focus. So in the case of Apple, I think it's all about the App Store. No one thinks, you know, it's illegal to be a monopoly in the US, but whether or not they have indulged in anti-competitive behavior, that is the key question. And look, these companies have to comply with the Digital Markets Act in the UK, in the EU a week from now. So as part of that, they have to make changes to the App Store. Basically, third-party billing will be allowed. And so that is a bigger risk for Apple than I would say Google or anyone else out there, because they generate a bulk of their high margin revenue from the App Store. And I think the Gemini thing is something they will work on. Look, these models are very iterative, so I don't think regulators will focus as much on that, given it's still an early stage technology.
You said that a lot of people would agree that these companies have too much power, and you talk about the App Store, but there's another aspect of power that's increasingly relevant in an AI universe, which is data. And how much is that an increasing concern in terms of protecting data, isolating data, harboring data as something that is bespoke and in-house that for privacy concerns and other things? How much is that a consideration at the conference you're at?
Yeah, I mean, look, at the conference, it looks like, you know, the telecom providers want to be participants in the training of these large language models. They don't want everything to be siphoned off to the hyperscale cloud providers. And enterprises actually care about the motion of data. So what I've been hearing more and more at the show is companies don't want to train their large, like the GPTs and the foundational large language models with their data. They don't want to be in the possession of their data, and that's where, you know, techniques like retrieval augmented generation, that's gaining a lot of momentum. But basically, there are different approaches you can use to make sure you don't let go of the data to these foundational players. And that is a big focus of the show.
Mandy, we were playing with the idea of who's going to regulate big tech better. Is it going to be regulators or is it going to be markets? How much are we starting to see a real sort of discretion being played by investors in terms of which companies are using their power correctly and those that aren't?
Well, so I look at it this way, there is so much innovation going on in large language models and generative AI. And at the show, I saw some demos from Xiaomi and Chinese phone makers around putting on-device AI. So clearly, the pace of this is just astronomical. And so any regulation that comes in at this stage, it's going to hurt, US-based companies or even, for the matter, companies that operate in the EU, because companies are still trying to figure out, what are the best guardrails to put. And if you put out a blanket regulation, that's going to hurt innovation because there are other companies that are trying to, move as quickly as possible in this domain.
Senator Warren yesterday talked about the major cloud services, Google, Microsoft, Amazon, and she said they should not be allowed to use their enormous size to dominate a whole new field, and that means blocking them from operating large language models you were just talking about. But these companies have the infrastructure and the capital to do it. If it's not Google, Microsoft, Amazon, Mandeep, who is it?
Yeah, you're right. And so there are companies that have developed large language models like Mistral, which partnered with Microsoft recently. And obviously, OpenAI, we know, did that in the early stage. And the reason they did it, because they need the compute and the resources. So what these partnerships do is to provide credits for these companies to run on a Microsoft infrastructure or a Google or an Amazon infrastructure. And even if, in the case of Google, they have the large language model and the infrastructure. There are other instances where a partnership actually works out better because at least you're allowing a startup to compete in this domain, albeit, they have to rely on compute and the resources from the hyperscalers. So that, I think hyperscalers will be part of the equation. Telcos are trying to become part of the equation, but clearly this is a high CapEx a game, and companies that can invest in CapEx are the ones who will have an advantage.
And Apple, we know overnight from our reporting, moving away from EVs, they're pushing into AI. What's your reaction to that?
I mean, one of the biggest themes at the show this year is on-device AI. I can't tell you how much it's garnering attention in terms of things that a native LLM running on the phone can do. And so when you think about, who should be out there with a native on-device AI, it's Apple. And I think everyone is waiting to hear how they are going about it. Clearly, they are, thinking of doing something relatively quickly. But I can see a lot of the features being rolled out, and some of them are very cool in terms of, personalized assistance to productivity features without actually sending your data to the cloud, which is a big deal in terms of protecting privacy and what.
Such a big deal. Why do I need that?
Well, so, think of all the things that you do on your phones, even the whole app ecosystem. Why are there hundreds of apps to make you productive? Why can't you talk to your phone in a way where, it can do things for you in a very intuitive way? And that's where we are going. It will be incremental. I don't think it's going to replace the entire app infrastructure. But the way things are working out, it's more about developing workflows around how you interact with your phone and what makes you productive. And that's where on-device AI is crucial. You don't want to be sending everything to the cloud and, be doing all the computation over there.
Mandeep, this is happening really quickly. Now, I won't name a company. I'll just say September is usually a month where maybe they might unveil a new phone. Is September too soon to roll some of this out?
No, look at Qualcomm. They announced, a new processor that can do on-device AI. So all the OEMs working with Qualcomm will already have a phone that does something, very similar to what Apple may end up doing in September. But clearly, it's not early. They should be out there with, something that excites investors, and that could drive a new refresh cycle. We know Apple has the install base, but it's all about putting it out there and making sure it works, unlike Gemini and you know what happened to Google with their launches.
Yeah, tough, difficult. Mandeep, thank you. Mandeep Singh there. Thanks for joining us out of Barcelona at the Mobile World Congress on the latest with Apple. I remember, and we talked about it earlier, when being in EVs was bullish. Dan Ives of Wedbush would talk about the next big phase of all this technology and all that stuff. And now all of a sudden, pivoting away from EV is bullish because you're going to focus on AI. And maybe we get that technology as soon as, say, September. They roll out a new phone, and then we get this big upgrade cycle that Dan's been looking for a long, long time.
It's people trying to envision how we live, how we sort of communicate with our devices, how we're looking for some sort of relationship with our devices. I'm thinking about, and I mean relationship, because how much are we going to go from people doing this to people, you know, having conversations with their phones? You know, tell me, do I look good today?
Is that what you want your phone to tell you?
No, I mean, this is what you know, Tanger Outlets was saying, that they'd like people to, you know, it might
just
it might
making
be the,
sure, Bramo,
you know,
that you're okay.
Well, I mean, I don't know if I'm okay, but
you know, like,
but I do think people are going to end up having relationships, you know, in a different kind of way.
Actual relationships with their phone. Bramo, let's leave that there. Coming up tomorrow, Wei Li of BlackRock, John Hancock's Emily Rowland, Neil Dutta of Renaissance Macro, Dime Brand CEO, John Payton.
Keep going.
You've got 10 seconds to clean it up if you want.
I don't need to clean it up.
All right, cool.
It's true. I mean, think about it. If you can talk about it, everything with your phone, this is what he's saying, rather than more intuitive than...
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
From New York City for our viewers worldwide, a very good morning. I'm Menace Crenny in for Jonathan Farrow. A little bit of a dip in these markets. Are we building up for a gentle bubble? I've never seen a gentle bubble. We can discuss. Countdown to the open kicks in right now.
everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, futures moving lower ahead of more crucial economic data. Rate cut bets converge. Traders finally capitulate and stop fighting the Fed. And President Biden and Donald Trump edge closer to the rematch. We begin with a big issue. The bond markets. Are they starting to capitulate?
Really what's happened in the bond market is it looks like the market got ahead of itself. It said, okay, this is over. Let's throw in the towel. Rates are going to go lower. Time to buy yields. And what's really happened is we're not there yet. And thus, we've seen a very strong movement in yields upward again. We've come back to a short positioning in fixed income because those moves have been pretty strong. And we're still trying to figure out what is the equilibrium rate in that environment for higher for longer.
Joining me now, it's Morgan Stanley's Jim Caron to talk about these markets. Jim, good to have you with us. Do you get a sense that those bond rate bulls have capitulated?
So I think we're in the process of capitulation. I wouldn't put it in the past tense. Effectively, what we're seeing is that inflation is coming down, but it may not be coming down as fast as what was hoped. And, you know, as people have been saying, we started the year with people relatively long fixed income. There were over 6 rate cuts already priced in. 10-year yields were below 4%. And now we're at a stage where many people are starting to push back on this and effectively starting to believe that, well, maybe the Fed doesn't, you know, cut rates in March. Obviously, that's not going to happen. But maybe it's June. And then the question is, well, maybe, you know, what if it's even later than that? So I think we're in this process of capitulation. And I do think that the risk is for the markets that bond yields move even higher. And I would argue that it's a risk case scenario that we could even get up to about a 4.5 to 4.6 10-year yield. I'm not forecasting that, but I'm saying that it's not an unlikely possibility if we continue to get inflation numbers that are not coming down as fast as hoped, and the Fed continues to kick the can down the road and decides not to cut anytime soon.
And this would be your base case, isn't it? That inflation is not cooperating, and that makes it much more difficult to call the top of these markets. Let's welcome our next guest in. It is Mike Schumacher. He joins me for the very latest. So there we are. We're debating whether we are, and quite rightly, Jim corrects me, we haven't capitulated. It is not the past tense. We may be in the present tense. I live in the present, which is we're in the process of capitulating. Give me your thoughts this morning, Mike, as we see this potential shift in the rates markets. We've come back to 80 basis points cut. David Solomon summed it up beautifully. We're changing our mind every 2 minutes. Good morning.
Thanks, Manus. I appreciate it. And with respect to the amount of rate cuts the Fed will do, I think people are too hung up on when exactly that first cut happens. So whether it's May, June, July, most reviewers are sort of indifferent. Yeah, the bond nerds like me, we care, but most people probably don't. As long as it's in that general time frame, it doesn't matter too much. The bigger thing for us is that when the Fed first gets that cut done, so people say, oh, now it's an easing cycle, then we think the market will price a lot more rate cuts than we have in place today. So for instance, typical cycle, Fed cuts about 200 basis points in the first year. We think that's still in play here. The market, if you look from June of this year to June of next year, is priced for maybe 115, 120. That's pretty light. So we do think yields come down, but they probably meander until that first rate cut.
Well, it's the debate, isn't it, whether it is the escalator or the elevator, and a lot of people are pushing back against the elevator straight to the ground floor. Gentlemen, stand by, because we are bracing for this week's pivotal data point. Excuse the pun. It's the Fed's inflation measure. It comes out tomorrow, and we're going to digest what that data means tomorrow. But in the meantime, we have a little bit more on our breakfast plates. Mike McKee is with me. Mike, good day.
Good morning, Manus. You live in the present, bond traders live in the future, and we all do it by looking at the past, which is what we got today. Fourth quarter GDP revised a little bit lower to 3.2% from 3.3%, but consumer spending and business spending were both revised significantly higher, suggesting that the economy had momentum going into the first quarter. The inventories number is the one that really pushed down the number by 0.1%, falling by almost $20 billion during the month. That's not likely to be repeated. We also get some quarterly inflation data, the PCE numbers. This is not what we get tomorrow. This is the 3-month annualized version of that on a month-by-month basis, and it does show that we're continuing to see progress on inflation. But this isn't, as I said, what the Fed looks at. They're going to be looking tomorrow at the income spending and PCE report. And what we have there is a forecast for slightly falling inflation on a year-over-year basis, even though we have higher month-over-month inflation. Now, that 0.4 increase in the PCE core for January that's forecast, a lot of people think it might be 5, and that would push inflation higher for the year. This is all because of that CPI PPI beat earlier in the month. Incomes expected to be up, spending expected to be down. The Fed will be watching that to see what's going on. Before we go, Manus, because we got a lot of Fed speak these days, I want to point out something that just came up this morning. Bloomberg News, Katerina Saraiva has interviewed Lori Logan from the Dallas Fed Bank, and Lori used to run the open market account at the New York Fed, and she had an interesting comment that maybe markets had taken her wrong when they thought that she said we should stop QT soon. She said she's surprised the market reaction connected slowing to stopping. We need to disconnect those concepts. Slowing doesn't mean stopping, but just means managing the pace. So while the Fed may in March be talking about slowing QT, the person who markets attributed the idea of stopping to says, no, that's not the case.
Okay, well, that's going to have an impact. Mike, thank you very much. We got data and an interpretation. Jim Caron, Mike Schumacher are my guests this morning. Mike, let me take it back to you. You, in your own words, you're the bond-focused man here. When you listen to the nuance from Lori Logan, she's not talking about stopping QE. She's talking about the nuances of slowing it down. Does that throw a fresh complexion for the bond market this morning? Should we pay more attention to this?
It is a nuanced point. I think Mike McKee's got it right here, and Lori Logan's the guru at the Fed. I certainly acknowledge that point. So people in the markets probably are getting a little bit ahead of themselves, thinking about QT taper versus QT stopping. They are different things. And part of the reason there's some confusion is the RRP program is relatively new. No one really knows what that critically low level is. So the Fed is trying to learn, markets are trying to learn. So whenever Lori Logan or someone in a similar seat speaks, people are going to adjust their expectations. It's not a great answer, but I think the move toward QT tapering, it seems likely fairly soon, but we're not quite there yet.
Yeah, well, it's taken us 10 years to understand exactly the implications of QT in the first instance, or QE. So it's going to take us more than a couple of months to understand the real impact of QT. Mike, can I just push you a little bit further? You said the market's pricing in 120, 150 basis points of cuts in the first year. Typically, you say that's 200 basis points. Would it take some kind of an exogenous shock? I don't know. I mean, commercial real estate. It could be another regional bank. I mean, you can throw any black swan up there and conjecture. But would it take something strenuous in the system to deliver 200 basis points of cuts?
No, we think not. So the reason why the Fed might do something like 200 in the first year this time is real rates are very high. So you think about the Fed funds rate in nominal terms, the effective funds rate's 5.33. Inflation probably stabilizes low to mid 2s, so call it 3% real, maybe a little bit less. If you look at the 10-year rate, the real yield's about 2%. Those rates are exceptionally high. And if they stay high for much longer, they're going to inflict economic damage, which probably is unnecessary, call it 6, 9, 12 months down the road. So the Fed can try to get ahead of that, and it's got ample room to cut a bunch and still maintain restrictive policy. It's a more nuanced argument than the Fed normally makes. Typically what happens is something breaks, the Fed eases to fix the damage. This time it would come in somewhat aggressively versus market expectations to try and forestall future damage. So we think there's plenty of room.
Okay, and of course, now the equity markets are still maintaining their stoic resistance despite the rates probability coming down to 80 basis points of a cut. I want to tune into what Amundi's CIO had to say this morning about pressure building on the equity market. Let's just take a listen.
The pressure is high because we see more and more brokers, actually, banks, but also clients which are capitulating in a way, wanting to catch up the momentum and feeling uncomfortable, not being overweight equities.
He goes on to say that equities are overpriced by 20%, Jim, which takes me to you. There is this burdening pressure to be in this market, to be long some kind of Mag 7 conjugation, some kind of breadth in the 493. You're adding to developed market equities. You are overweight. And your thesis is, I have a job, I'm well paid, I can spend, baby, spend.
Well, you know, I think it's really a question of where we think earnings are actually going. So one of the things that we always get asked is, where do you think the equity market's going to be at the end of this year? So on December 31, 2024, what's the price? Well, what I'm going to do is I'm going to look at 1 year forward earnings at the end of this year. So really, I'm going to look at all of 2025 earnings estimates for what that, you know, for what that might be. And then I'm going to multiply it times the PE ratio, which is somewhere around 19.5. So effectively, bottoms up consensus earnings for 2025 is about $275, actually $276. If inflation's coming down, if we're in a more stable PE environment, if Mike Schumacher's right that the Fed's going to control this in a good fashion, then multiples can probably stay into that, you know, 19.5 level. Then if I multiply the 19.5 PE times a 275, I get a number on the S&P for somewhere around 5350, 5380. And essentially, that is what the market is figuring out, if it believes that we're going to get those forward earnings 1 year out. And essentially, the more data that comes through that's not weak, the more the likelihood is that we don't fall into a hard landing, the more believable that 275 number is for 2025. And then we just have to debate what the multiple is. And effectively, it tells me that it's hard to be underweight or push to an underweight in equities right now, unless you're just, you know, betting on some unforeseen, you know, event or something like that. And I would argue that actually bond markets might actually be a little bit more overvalued than equity markets right now. So I would disagree a bit with you know, my colleague from Amundi.
That's fine. That's what healthy discourse is in a bid and an offer. Mike, let me just take it straight back to you, because David Solomon said this: there's such a high consensus, such a high correlation around this narrative that we're going for the soft landing. It's got a very high delta to a soft landing, and my own view is that it may be a little bit more uncertain than that. Do you see any evidence that it's going to be a bumpier road into the back of 2024? Because right now, markets are priced to the soft landing Goldilocks. Briefly, sir.
Yeah, we do think there's a decent chance it's bumpy. I would say it's already a little bit bumpy when you think about the CPI print high. Obviously, a jobs report last month was very strong. And this probably shouldn't surprise anybody too much. When you think about the backdrop over the last 3 years, what have we had? Amazing increases in inflation globally, not just in the U.S., huge drops. Is it really too far-fetched to think that getting inflation down from 3+ to low 2s is going to be a challenge in a lot of countries? I think it's not. And also, you still got the residual impact of COVID in terms of nearshoring, onshoring, whatever you want to call it. That's probably inflationary, but the effects aren't all that clear-cut. So a bumpy road, that seems pretty likely to us.
Okay, gents, thank you very much. We've got a little bit more work to do. Don't hang up your Zoom line just yet. Jim Caron and Mike Schumacher, my guests this morning. Let's get under the hood of these equity markets. We've got 17 minutes to run till the opening cash bell. Abby is with me.
Well, Menace, overall, we do have the stock futures down modestly. This has to do with something we haven't seen in a while. NVIDIA down more than 1%. But let's take a look, and you can see that there on the bottom of the board there, down 1.2%. Apple not down so much, but it's worth mentioning because we do have this small move, but on big news, of course, there They're abandoning their decade-long plan to develop an electric car. Investors, not a lot of stock reaction because it was never in the financials, but certainly a headline reaction. Beyond Meat, take a look at how much the stock is soaring, up 60%. The pandemic, darling, getting a nice bounce on revenues being 10% better, changes to the portfolio. There is a 39% bearish short interest, so much of that I'm betting is a squeeze. And then finally, the crypto rally continues. We have Bitcoin back above 60,000 K, the highest level since November of 2021, and it's taking those crypto stocks right along with it, Manus.
Yeah, and a number of people speculating that we could have a gentle bubble. I've never seen a bubble burst gently. Capital groups say that. Coming up in the show, Abby, thank you very much. We got optimism in Washington.
We have been working in good faith around the clock every single day for months and weeks and over the last several days, quite literally around the clock, to get that job done. We're very optimistic. I hope that the other leaders came out here and told you the same. We believe that we can get to agreement on these issues and prevent a government shutdown, and that's our first responsibility.
From behind the closed doors of the White House, we take you into the conversation right here on Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
This is Bloomberg. I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Progress in Washington. Do you trust it? Congressional leaders expressing confidence while avoiding a shutdown, expecting to reach a deal ahead of Friday's deadline despite the remaining hurdles. What are they? And do you believe them? Amy Hordern has been parsing the rhetoric. Good morning, Ms. Hordern. What do you believe has changed? What shifted?
Well, they're talking about progress, but really what they're trying to do is just delay. What they're looking to do from Punchbowl News, what we learned is that Speaker Johnson wants to move the two deadlines to, instead of the 1st and the 8th, through the 8th and the 22nd of March. So this would give them time to get some of those top-line figures in place. He wants to make sure there's top-line figures in place with the Democrats on 4 of those appropriation bills that would be due midnight on the 1st, if that deadline was going to move to the 8th, because also you have to remember, he wants to make sure if he's going to put a continuing resolution on the House floor, that he can preserve his job. So he has to show the hard right flank of the Republican Party that he is working to try to get a more fiscally healthy, what they would call budget, and potentially some of these policy riders, Manus. How much can the Republicans extract from the Democrats? That remains to be seen, but it does look like they are kicking the can down the road, and they need to, because there are some Republicans that have really tough, not just primary races, but races coming in November to win re-election. And if you have a government shutdown, some employees are not going to get paychecks. And speaking of some of those difficult races in some of these swing districts, yesterday we did have a swing state with a primary, and that was Michigan. And that shows by Manus, for both Biden and Trump, some general election issues. The former president is still not getting 70% of the vote. He's more closer to 60% of the vote in all of the past primaries. So he has some more work to do to shore up the Republican voters into the general. And then for Biden, more than 13%, that's more than 100,000 voters in Michigan voted uncommitted. A lot more work needs to be done with the younger generation, progressives, and Arab and Muslim Americans, because they do not like right now what he's doing in Gaza, and that was a protest vote to the White House.
Yeah, a very clear protest vote, Anne-Marie. Wonderful what self-preservation does for a politician in terms of getting deals done. Anne-Marie Hordern, thank you very much. Jim Caron, Mike Schumacher are my guests. I mean, a shutdown in of itself, Mike, does not shake the market. When does another message from the ratings agencies shake a politician into understanding what fiscal policy should be?
Yeah, you probably have to wait for the debt ceiling battle, which is coming. So the debt ceiling's been pushed out to Jan 1. Sometime after that, you'll get I'm sure, a contentious battle. So perhaps Manus in the lame duck session of Congress. But if that seems to go badly, you'll get more, I suspect, more pressure from the rating agencies. So I think we get to wait until that. It's not so much the shutdown, it's the debt ceiling.
I wouldn't imagine, Jim, you know, this market isn't going to be terribly worried about this shutdown. But what I do want to get a sense from you both just very, very quickly is we've got this plateauing in rates at the moment. We look at the political situation. How does it stack up for the dollar, Jim, in your mind?
So, I mean, on paper, all of this should be dollar negative. But the issue that we have is when we look around the world, the U.S. still has very high real rates. You know, Mike Schumacher was just talking about that right now. That makes the dollar attractive on a relative basis to other currencies. U.S. equity markets, U.S. asset prices are actually doing relatively well versus other markets around the world. So there's an attraction to own the dollar, to own the U.S. assets. So those two things override what should fundamentally be a dollar negative. It really turns into a bit of a dollar positive. So our view on the dollar here is relatively neutral. We don't have a very strong view. We don't think it's going to collapse. We don't think it's going to necessarily accelerate. We think it's really just going to move a bit sideways.
Yeah, I had BMO this morning with me talking about the high correlation trades, and he's worried about the barbell. Mike, can I just close it off with you? Extrapolate forward. We're going towards Super Tuesday. The narrative is it could be a Trump victory in the White House and a sweep for the GOP. What would that do to the dollar? Briefly, in 60 seconds. Jim. Mike, sorry. Mike, my apologies.
Yeah, it should be dollar positive. So you think about Trump 1, what do we have? Trade war, a lot of restrictions, a lot of talk about NAFTA, which became USMCA, a lot of saber rattling. Probably get more of the same. People look to the U.S. dollar as a haven, a place of strength. So I think that's dollar positive in that particular case.
Okay, gentlemen, thank you very much. Let's see how it all falls down as we head towards Super Tuesday and the risk of a government shutdown. Jim Caron, Mike Schumacher. My guest this morning on the markets. Coming up, morning calls for you. A conversation with Sarah Hunt of Alpine Saxonwood. She joins me around the opening bell to discuss her outlook for the equity market. She breathed a sigh of relief when NVIDIA delivered their results. Should we continue to breathe easy? Good morning from New York.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Almost like a daily vicissitudes of what drives the market. NVIDIA is down 1%. You have the results, you have the glory, and yet we managed to look at markets through the prism of one stock, never mind the Magnificent Seven. We're now down to the daily vicissitudes of what NVIDIA does to drive this market. That is a dangerous place to be, and it has the hallmarks of something that is not built on huge strength. We can debate that with Sarah Hunt when she joins me in a moment. SPOOs are down 1/3 of 1%, NASDAQ down 1/2 of 1%. These bond markets are topping out at the current level. We need the PCE to come in hot to drive them higher. Some notes for you from the Wall Street Scribes. Bernstein downgrades Stellantis to market perform. They see limited upside after recent gains. Next up, Stifel upgrades JM Schmucker to a buy, highlighting the compelling valuation, the potential for near-term growth. And finally, Loop Capital initiates coverage on Dell Technology, a buy rating, expecting the company to benefit from, you got it, general AI trends. Sarah Hunt will join me next. How dangerous a place are we with our obsession and myopic focus on NVIDIA? Good morning from New York.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Mike Schumacher on from Wells Fargo. He says, do expect up to 200 basis points of cuts over the next year. This rates market has underpriced the rate cuts. They're still quite exuberant at Goldman Sachs Asset Management. These equity markets are nervous. Nvidia's lighter by 1%. So a lot of the earnings stories that are coming through at the moment. But for now, we pause for thought on this technology-infused rally across markets. And in terms of the rest of the assets, I really want to look at that Bitcoin. We've actually changed the total rundown. There you go. Bitcoin made it onto the asset display because she cracked 60,000, up 39% in the month, the biggest monthly gain since October 2021. This is a rising tide across assets, and the question is, are we building up a little bit too far and too fast? Rates remain unchanged, 429. There may be a little bit of a further backup in rates as we go towards the PCE and afterwards. And oil is up by 0.5%, despite the build in stockpiles in Cushing, Oklahoma, up 8 million barrels. And a warning that China oil demand could be in a low growth phase. Doesn't seem to knock the market for now. One stock we are watching, it is eBay. The company reported a strong holiday quarter, expanding its share buyback. Yep, that word again, a share buyback of $2 billion. Abigail Doolittle is with me on the note.
Well, investors are really liking this quarter and that buyback, Manna. Shares are popping higher, up more than 6%, heading to the best day since November of 2022. So relative to the quarter that was, as you mentioned, it was a strong quarter, a strong holiday quarter. They beat both top and bottom line estimates. In addition, relative to the buyback, they added $2 billion to it. So there's now a total of $3.7 billion in that buyback. But on this solid quarter, the hopes are really for the future, because if you recall last month, they cut about 9% of their workforce, about 1,000 people. So the thought is if they can continue to have strong sales and compete with the likes of Amazon, those cost cuts will flow to the bottom line. They really are in some niche markets such as watches, sneakers, and luxury items for collectors. They also sell authentication services designed to root out counterfeits. And if you can believe this, online, refurbished appliances and car parts for the cost-conscious American. Now, you put all this together with those cost cuts, and investors probably hoping that this stock can finally pop out of a greater than year-long range between about, let's call it 40 to 50 today. Not quite there, but nonetheless up 5%.
I've got to join this whole car revolution. I haven't had a car in 8 years. Abby, thank you very much. Abigail Doolittle. Stick with the earnings front. Baidu's profit cut almost in half after the spending on AI to keep up with the market. Alex Semenova joins me. So spend on AI, but there is a risk associated with that.
Indeed, Manna. Some back and forth action for Baidu this morning. Shares now falling into the open. It fell, then rose, then fell again in pre-market trading after a mixed earnings readout. Baidu, which is of course China's dominant search engine, reported revenue growth of 6% on artificial intelligence applications and its ad business. That was, however, overshadowed by a 48% profit plunge. Profits nearly halved, underscoring how costly it is to train and develop AI as companies foray into this area. Baidu does, of course, make the bulk of its profits from its ad business, but as China's economy slows and consumers cut back spending, it has been foraying into AI, joining the likes, of course, of Silicon Valley peers like Google. Its ChatGPT-style service attracted 100 million users and now gives a premium tier that charges a monthly subscription, giving it a head start against some rivals in China. It has, however, had a difficult time. Shares have dropped nearly 30% since July in Hong Kong on concerns about that ad business and the costs of AI. Analysts at Bernstein say successfully revamping its AI apps are the most critical part for Baidu's AI story. Nanis?
Well, everybody wants to know what your AI strategy is. Alex, thank you very much. More earnings this time on the retail front. You've had a few already this week, but Urban Outfitters missing their estimates due to a slowdown in January across the brands. Isabel Lee has more on the story. Stock under pressure this morning. Isabel.
Definitely under pressure, Manus, because it's a miss on the top and the bottom line for Urban Outfitters. During the pre-market trading, shares were down as much as 11%, and now we see some paring back of those losses, but still down around 7%. So we have the clothing retailer reporting adjusted EPS that missed estimates, and Citi attributed this to weaker comparable sales and gross margin due to a slowdown in January across all its brands. Citi did say that it expects improvements for the brand this year. So we have adjusted EPS at 50 cents. That's lower than the 74 cents estimates. The bottom line did increase in the previous quarter, and we have net sales at $1.49 billion, which is in line with estimates. So Urban Outfitters is an umbrella for a lot of brands like Urban Outfitters, the namesake, Anthropologie, and Free People. The namesake brand beat sales expectations, but Anthropologie and Free People kind of fell short. Despite that, we have the CEO telling investors that the spring offering usually bodes well for the company. So I guess we have to look out for their fashion choices. And we also have Telsey Advisory Group, though, being slightly optimistic towards the progress that the company will be making this year. It also raised the price target of Urban Outfitters as well as BMO. And shares now are continuing its plunge down around 10%. But in the past 12 months, Manus, the stock is up around 75%.
Go Urban Outfitters. Isabel, thank you very much. Just coming off that massive rally. Let's stick with the retail earnings. TJX delivering what could be called a tepid outlook. Its annual sales forecast misses the estimates. Simone Foxman has more. Simone, what's going on at TJ Maxx?
Yeah, once again, we are hearing from a retailer that says the fourth quarter, in this case, which ended at the beginning of February, was really excellent, but the coming year is looking a little soft. And this, TJX, the owner of TJ Maxx, Marshalls, Home Goods. So sales topping estimates in the fourth quarter up 13% year on year. Comp sales up 5%. The estimate had been 4%, and the company had guided 2 to 3%. So that is a very strong beat. And a lot of actually enthusiasm coming from Home Goods, which seems odd since consumers have seemed reluctant to spend on their homes, just considering the high interest rate environment. Also saw profit margins coming in strong at nearly 30%. William Blair called this a healthy beat. They pointed out the volume of consumer transactions. But to that guidance there, 2 to 3% comp sales expected both in the first quarter, especially maybe on the back of a slow a slow February, and then comp sales looking for full year to 2 to 3%. The estimate had been close to 4% on both of those. Company will increase its dividend. That not really helping shares today, but Citi, Bloomberg Intelligence, all immediately out with notes saying they believe that this guidance is conservative. And it is worth noting that shares of TJX hit a record high yesterday. So maybe we've just seen the enthusiasm top out here.
Believe, Simone. Believe in the retailer, I say. Simone Foxman there with the very latest on TJX. Sarah Hunt is Alpine Saxon Woods. She's navigating what lies ahead, telling the market this. The market reacted positively and well to NVIDIA earnings last week, and we had a sigh of relief and heard around the investment table. It was palpable. Sarah joins me now. Sarah, it really was. It was the build up to the crescendo. Then we got the numbers. Then we breathed a sigh of relief. I look at what the CTA does. They piled in. They put $15 to $20 billion more into the markets post NVIDIA. What action did you take when you had that sigh of relief?
Well, I think that everybody was waiting to see what was going to happen there. I mean, Microsoft had already put up good numbers, and AI was a part of that. I mean, NVIDIA is really just the poster child for what's happening in AI, and that story has really driven the market. We were already fairly well positioned into that, but I think that the question is always about going forward. Had there been a problem, however, I think that the equity markets would have had more trouble than just the fact that it was NVIDIA. I think it would have that story would have started to have some cracks in it. And so far, that story is still looking pretty good, and that's been positive for equities.
When I look at these markets, I look at it through the prism of the average investor, which is I for future, for 401k and retirement. And the greatest risk of all is, oh my gosh, are they going to dump all my capital in all at one go? And that's into the highs. Do I just hope for a bit of a correction? I mean, some people are talking about, a gentle bubble. I mean, you can miss out if you sit too long waiting for a gentle bubble to explode.
You can, and I think, this is part of the reason why so much of that kind of investing is done on a monthly basis, where you're putting in, especially for 401ks, you're putting in money all during the year, because it is very difficult to start if you had zero money invested and look at this market and say, I want to put 100% of my money into it. But even when you do get new investors, you put money to work in tranches so that if there is any kind of a pullback, you get to take advantage of that. But also, if the market keeps going up, you're not just continuously left behind. And that's really been the issue for the last year and a half. I mean, since 2023, when the market really took off, especially on the tech side, that's been a problem because waiting for pullbacks, they haven't lasted very long, and you have to be very nimble to catch them. So that's where monthly investing comes in handy when you're participating in a 401k.
It does indeed. There's a couple of things that have come to my mind this morning. One is from David Solomon over at Goldman Sachs. He says, he spoke at the UBS conference yesterday, so we've dealt with his view on the high delta for soft landing. Consumers are now living paycheck to paycheck. Spending behaviors of that nature are coming to the fore. I'm also looking at mortgage data this morning, which is virtually ground to a halt. The two idiosyncratic pieces, one is subjective and one is data, but they are nonetheless, I say, quite telling.
The big problem, I think, going forward is that if you see any issues in the labor market, you are back to the point where, especially on the low end, the consumer is quite up against it with higher prices and higher cost of living. And I think that this is where, if you start to see any labor issues, the market's going to take that and say the consumer cannot keep spending if they lose their job, because we're back to a situation where a lot of that pandemic excess savings has been spent. And wages have risen, but they haven't necessarily risen commensurately with inflation. Mm-hmm. And so that becomes a real tension. And I think that that's where, especially on the lower end on the consumer, there are a lot of problems there.
Are you surprised by that chart? We're just showing it, the home buying near the lowest level since 1995. I just got a mortgage in 1995, and it was about 6.5% in pounds. So I'm used to that number, but this world is not.
I think that's the problem, is that not only is the world not used to it, but because many people were able to refinance their mortgages at lower rates, you have a big group of people holding on to mortgages that have a lower number to them, and the people who are trying to buy, the pricing hasn't come down enough to make those higher interest rates affordable. And that's the problem. Affordability is really not helping anybody right here, and this is one of the tensions in inflation numbers, right? Because as the owner equivalent rents keep going higher, it's harder to bring inflation down. And that's become a consistent issue. We have lower housing stock, and it's very difficult, again, to see turnover in the existing home market, which is why you've seen much higher numbers relatively on percentages for new home sales.
You and I have talked before about robust balance sheets, look beyond Magnificent Seven, etc., when it comes to discerning where you want to be. But you would make the point even stronger now, is that robust balance sheets outside of tech are going to become even more important. So where do you see those opportunities, Sarah?
There's some good places. I mean, I know that we've talked about energy before. There's some good places there where you're seeing cash flow and you're seeing good balance sheets. I think even in some of the retailers, I mean, for the fact that TJ Maxx is going to up its dividend and increase its buyback tells you that they've got a strong cash flow situation. I think if rates are going to stay higher for longer, and certainly the way the curve is interpreting what the Fed has said and what the economy is doing, is that is going to be the case. And again, people start really looking at those balance sheets, because nobody wants to be in the position where they have to raise a lot of debt in a higher interest rate environment. So I think that this is really going to come more and more to the fore as valuations start to become in other parts of the market as important as some of those cash flows on the tech side.
What do you take away from the nuances? Capital Group says we have a gentle bubble. I've never seen a gentle bubble burst in my life. Cathie Wood is slicing some of her chip holdings into this rising tide. Again, these are very subjective opinions and actions, and we usually get the actions after, the horse has bolted. But is there merit, Sarah, at any level? We're trying to decide whether to go all in at record highs or to shave back risk at some juncture. It's a very, very hard call to manage, isn't it?
It's a hard call to manage, and as one of my colleagues likes to remind me, there's nothing wrong in making some money in stocks and taking some money off the table too. I think the harder question is really where are all the assets going? And this is where there's been a lot of tension right now. And to the extent that technology just continues to permeate our lives in ways that we weren't aware of, nor do we sometimes even want. You don't need a refrigerator full of semiconductors, but you're getting one anyway. There is a consistent growth in unit volume in some of those areas that's not going to go away necessarily. And I think that that's where people are trying to figure out how much of this is short term, how much of this is much longer term. And unlike the dot-com bubble, which has been, there's been a lot of parallels made, at least there's a lot of earnings backing up and a lot of cash flow backing up what's going on right now, even though some folks are obviously putting AI into anything just to make it, to be part of that story. But it's not as bad as it was in the previous cycle when you had a lot of money chasing very few profits. At least now you've got a lot of cash flow behind some of this.
You have indeed, and the one thing I'm looking at is I just ran, anybody who's got a Bloomberg terminal, run NI hot and have a look at the word buybacks. It's the most splendid roll call of everything under the sun. BMW, Munich Re, Baidu, along with BP and Meta. It's a heck of a roll call on the buyback front. Sarah, we can talk about buybacks next time you're with me. That's Sarah Hunt, Alpine Saxon Woods, my guest this morning. Coming up, Apple slams the brakes on its EV venture.
We sort of see it as the mother of all AI projects. It's probably one of the most difficult AI projects, actually, to work on.
We'll have more on the details on that brake slamming move and the shift to more AI at Apple on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women.
sort of see it as the mother of all AI projects. It's probably one of the most difficult AI projects, actually, to work on. And so autonomy is something that's incredibly exciting for us. And but we'll see where it takes us.
That was Tim Cook a few years ago, speaking to Bloomberg on the aspirations. That was 2017. Today it's 2024. That was the big plan and the big idea. Those ideas have been scrapped. It's a decade-long effort for the company to shift into gear in the auto industry with EVs. Now the pivot is to do more in AI. How the world has changed. Ed Ludlow, good morning. Good to see you. I mean, this is pragmatism in terms of capital deployment.
Yeah, it's pragmatism, but it also shows you that you can have $170 billion of cash on your balance sheet and it makes not one bit of difference to your ambitions. You know, Apple's down 0.4%. When Mark Gurman broke the story yesterday, it did take a little spike higher. And what we're learning is that the 2,000 or so people working on the Apple Car project will either, unfortunately, lose their job or be shifted to a different team within Apple working on their generative AI efforts. That soundbite that you just played from Tim Cook from 2017 speaks to the story, which was Apple never really arrived at what product it wanted to build. You know, we reported recently that there had been a shift from aiming for a kind of all singing, all dancing, completely self-driving robo-taxi and paring back those ambitions to having something more like a level 2+ consumer car, like higher spec, in line with the kind of premium product emblem that iPhone and MacBook has. You know, a lot of people that I've spoken to throughout California in the automotive, but also AI industries, have interviewed at Apple at one time or another in the last 2 years to work on that car project. You know, at one time there were 5,000 people working on it. 2,000 now kind of face an uncertain future. But this is them, you know, ripping the Band-Aid, as Dan Ives put it. I would say that a number of analysts on the street note this is probably potential upside for Tesla, because had Apple ever got there, it's Tesla they'd be competing with, not with the legacy names like GM and Ford.
Yeah, well, it's still a big shift, and to a certain extent, it puts more pressure on the team to come up with innovation on product. Talk me through what's going on at Google in terms of their AI. It's not behaving exactly as it's supposed to?
Yeah, and I would also point out Alphabet shares are now down 2% in the session. They were down 4.5% Monday with a reprieve yesterday. Sundar Pichai sent out a memo to staff overnight, basically one acknowledging that results from Gemini, both text and image results, had caused offense. He labeled them as totally unacceptable. And what he explained to staff in the memo is that Google, Alphabet, the parent of Google, got this wrong, that the generative AI tool has some inherent issues that are leading to inaccuracies and problems of bias. And so now teams are working around the clock. You know, read the memo that's printed in full by Bloomberg, but they are working to fix this. And, you know, one analyst I spoke to yesterday from Elias Research basically said, this is an issue of trust, right? Because if you think about the story of AI with Google, it's about putting it in their other products. They've got a black eye now on the trust issue. How do we feel then about YouTube and search, things like that?
Okay, well, we'll keep an eye on it. Ed, thank you very much. Ed Ludlow there with the very latest on Alphabet. Some sector price action for you this morning. Abigail Doolittle is in the studio. Abby.
Well, Manus, we are looking at a small decline for the S&P 500. Nonetheless, we have more sectors higher than not, led by energy, financials, industrials. To the downside, though, we do have tech. You were mentioning earlier that NVIDIA down by about 1%, dragging. We also have communication services down about 0.8%. Now, dragging on communication services are a number of names. Most of the stocks in that index are down, including Paramount on the news that the deal with Warner Brothers, or deal talk, has really been halted right now. But one stock that is not going in that trend, take a look at Disney, up about 0.3%. And this, of course, amid the announcement earlier today that they are creating an $8.5 billion streaming alliance in India. And then we have discretionary, just about flat. Take a look at Wendy's. The stock really not moving that much, but lots of news beneath the surface, including Senator Warren posting on X recently about their price surging plan and really not liking it. In fact, the company itself is pushing back after, quote unquote, outrage over their surge pricing idea. Folks not liking the idea that supply and demand might drive the pricing over at Wendy's.
Okay, Abby, thank you so much. Abigail Doolittle. Coming up, market moving events to set the agenda for the rest of your trading day.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Lighter on the growth numbers for the fourth quarter, coming in at 3.2%. United Health has also done a little bit of tech pressure this morning, the likes of NVIDIA, and we've just caught up with Ed on Google there. So we're nervous. We're nervous ahead of the PCE. Trading Diary, this is what we've got for you for the rest of your day. The Atlanta Fed President, Raphael Bostic, speaks at noon Eastern. Plus, we get more Fed speak. Collins and Williams. Salesforce report their numbers after the bell. Thursday, it is the PCE, and that takes you to Friday. The risk of a partial government shutdown. The deadline, we're counting down to it. That was countdown to the open. Join me tomorrow morning. Let's see what else we can bring you on the equity market board. That's it from New York and Bloomberg. Good morning.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We have got Alex Steele, Paul Sweeney.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I did that all in one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
And we are brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. What is up with Bitcoin? John was just saying,
seriously,
almost $61,000 per token.
Is that just a straight up like risk on thing? I mean, we're going to talk to Mike McGlone, I think, over the next couple hours. Like, is it just risk on?
I don't know. I mean, you think it would be more correlated to the stock market a little bit, but I mean, it's just ripping here. And I guess what I understand, the two drivers are the spot ETF, so there's some buying there, and this halving situation, which is HALVING, which is starting next month. The amount of new Bitcoin that can be mined per successful mine is going to be cut in half. And Michael explained that to us. So that just means the supply will be growing at a slower rate.
Isn't that like cornering a market? Is that okay?
I don't know. There's somebody writing a computer program somewhere that kind of decided it should be that way.
Ether ETFs might be a thing, maybe. So there's that.
Yep.
I don't know.
We'll check with Mike McGlone. He's ensconced down in South Beach, kind of where all the crypto hipsters are, so he's down there. He'll give us the latest here. As John was just reporting, kind of got some red on the screen here today. Let's see what's happening under the hood of News Equity Markets. We can do that with Alex Semenova. She covers all the markets for Bloomberg News. Alex, what do you got for us?
Hey guys, it's great to be on with you. So it's a down day in the market, but it is a good day for Beyond Meat investors. The stock surged as much as 61% today. It did perish some of that gain, but it's still up. I see nearly 49%, kind of trading like a meme stock. These are the biggest moves since 2019. This, of course, comes after the company reported fourth quarter net revenue that came in ahead of estimates. It also issued better than expected margin forecast for next year, for the year. And CEO Ethan Brown said that the company would steeply reduce operating expenses and cash use. It's been struggling a bit to retain customers. The market a little tough for plant-based meat, and also it's more expensive, so consumers have kind of probably stayed away from it. Barclays analysts did note that while management is taking steps to reduce costs, there are no proven results that have emerged just yet.
You know, if you think about it in a supermarket, you have to search for this stuff now.
Do you really? I don't have to in New York.
Really?
Yeah.
Yeah, I mean, it's
right
maybe
there.
our stores are like monstrous out in the burbs, and it's got this little teeny tiny part of, in some little case, whereas before it used to be like promoted big time and everything.
Oh,
Now you have to
interesting.
search for it.
I mean, I live in the bougie Park Slope,
Yes.
where we like these things, so
Okay.
it's a whole different story. But I gotta say, short covering.
Yeah, it's there's a great story out from one of my colleagues, Carmen Reinecke, about a potential short squeeze given how this company has performed.
But I'm looking at the stock, I guess back in July of 2019, $234 per share. We're sitting here at $11. So, okay, it's had a nice move up, but
And fair enough.
yes, exactly.
But
exactly.
it's still really down. What else are you looking at, Alex?
Another name I'm watching is Bumble. Shares are falling today. Pulling up my terminal right now. Looks like they're down 7% right now. The online dating platform reported fourth quarter average revenue that missed estimates and issued first quarter guidance that was weaker than forecast. The company also did announce that it would cut about a third of its workforce. That's about 350 jobs. Bumble is, of course, undergoing a big organizational shift. Its founder, Whitney Wolfe, recently stepped down, and Lydianne Jones, who joined from Slack, has now taken the reins. Analysts found the results and outlook to be disappointing. Piper Sandler flagged execution issues for Bumble.
Now, which one's Bumble again?
Is this the one where the women
Yeah, this is
initiate?
the one where women reach out
Initiate.
to men. But there's also a Bumble for Friends part of the app, so you can make friends on the app as well.
Wow,
And how do you know if somebody wants to make a friend or something else?
I believe they're separate categories.
Oh, you
I've
believe?
never personally had that.
You've never, okay.
Wow, I didn't know you can make friends on that. Well, I guess the whole point with these dating apps is that once people date and they hook up and they go off, you lose them, right? So you either have to replenish that very quickly or you have to broaden out, right? I mean, isn't it Match.com?
Why are you looking at John Tucker? I mean,
Oh, sorry.
I thought it was a tuna fish.
Yeah.
Alex, it's funny that you mentioned that. There was actually a lawsuit
Bumblebee,
recently.
yeah, okay.
There was a lawsuit recently where they spoke about how these apps are designed to keep users coming back, which kind of contradicts the point of like meeting your significant other.
Or you expand it to like, here's wedding planning, here's financial planning. Like that would make sense. Be like, make your friends here. I don't know. That feels really niche. John
Remember
Tucker,
the,
though, you could do
remember
that.
the dating game? You're old
Yes.
enough to remember. Who was like their most famous contestant? Who was the serial killer? What's his name?
Oh, Bundy?
Yeah.
What? Ted Bundy was on a
Ted Bundy
dating show?
was on the dating game. So that's when I think about these dating apps and all, I think immediately back to like
Where's
a
the vetting
serial
on
killer.
that? Yeah.
Exactly. Where's the vetting? So when you go back to your desk, Alex, just Google real quick the dating game, a couple little video clips.
I think I've seen that clip somewhere in a movie or something.
Well, just in general, the dating game
Back
was
in the
a
olden
crazy
days.
concept.
Oh, like women were crazy about the guy.
Yes. You're
Wow.
right. All right, what else, Alex?
Last name I'm looking at is Baidu, which is, of course, China's dominant internet search engine. Shares are falling today. They were a little bit mixed in pre-market trading, falling, then rising, then falling again because the earnings report was quite mixed. It reported fourth quarter revenue that rose 6%, but that was overshadowed by a 48% profit plunge. Profits nearly halved, underscoring how costly it is to train AI models. This company, of course, the bulk of its revenue came from its ad business, but as China's economy has slowed and consumers cut back on spending, Baidu forayed more into AI, but that is costing them so far.
Yeah. All right. Alex, thanks a lot. Really appreciate it. Alex Semenova,
Thank you, guys.
Bloomberg Equities reporter, joining us there. And we also got that data that was pretty solid, right? You get a second quarter, the second read on the fourth quarter GDP coming in a little lighter than estimated, but really that was an inventory issue. The personal consumption part added about 2 points to that at 3%. Again, super solid. It's a big head scratcher.
It is.
Joining us now, Henrietta Trey's managing partner and director of economic policy at Veda Partners. Henrietta, there's a lot to get through. There's this, there's politics. But if I'm Biden's campaign, do I like these numbers?
I mean, there's a double-edged sword here. On one hand, you want the Fed to cut interest rates. Not that they're encouraging them to or in any way manipulating it, but the perceived benefit of the Fed cutting interest rates is something that any administration running for re-election would like to see going into an election year. But simultaneously, strong GDP growth, which is what we're forecasting and expecting and is consensus at this point, and even being revised upwards by NABE and groups like it, is also a strong indicator. So I have to say, I don't know that there's losing data for Biden in the upcoming economic information that we're about to be getting out. What you really want to see, and I think is a really interesting dynamic, is actual inflation come down, particularly on household goods and groceries. There is a study that I conducted a few weeks back about the gap between women's perception of the U.S. economy and men's perception. And in a number of cases, it's 60, 70, 80, even 93% negative views on the economy from Republican women. And it's an outsized portion of women versus men who believe the economy is struggling right now. And that's mostly because of inflation. So I think the most important data for the Biden campaign writ large is really just inflation on household goods and groceries.
So on that end, I guess, Henrietta, tomorrow's going to be an important day here with the PCE deflator data. What are you expecting to see here?
I mean, we've seen economic expectations and forecasts for consumer sentiment come down. You have to think that there's some inflation-related components to that, but it could also just be that the 4-month rise that we've seen is, just sort of plateauing or something along those lines. So I don't think inflation is going to be cured by any stretch. PCE is still going to be a problem. I think it's just really slow going and a struggle for the Fed, which is why the market is repricing so aggressively on whether there will be interest rate cuts. One of the conversations that I used to have a lot was, how many cuts are we going to get, between March and June? And now it's more a question of, are they actually going to cut in March or will it come in June? And I think that signals that there's still a long way to go on inflation.
Right, like no longer how many, but sort of when it actually starts. It does feel like maybe some of the repricing has finally worked its way through. Henrietta, tie this into the Michigan primaries yesterday. What did we learn? And I say that because it did feel like anti-Israel, pro-Palestinian group there really sort of put the screws to the Biden campaign, right? And I wonder how much that's going to start affecting the campaign versus, say, how much I'm paying for eggs at the grocery store.
Well, obviously Michigan is a critical state. There's 200 to 300,000 Muslim or Arab voters in that state. Biden was able to win the state by 150,000 last time around. So he does have a cushion. But, if female voters, if youth voters, if Black voters are migrating to Trump, which is what the polling is suggesting, but not necessarily representative of primary turnout data, then you have a problem when every vote counts. In 2016, the threshold was just a couple, 10 or so thousand voters. So you really want to work for everyone. But I think there's a misunderstanding of what happened last night because a lot of the takeaways were sort of gelled in the public consciousness a little early in the night. It takes 15% for the undeclared vote to send a delegate to the DNC this summer. And they're only at 13% as of this morning. So this is really the last hurrah in terms of big national attention that Michigan and these voters specifically are going to have in a way that I think will carry any of the weight that we've seen for the Biden team to be worried about for the last, 3 or 4 weeks. Not that they're not worried about the Israel-Gaza situation in general. They asked for a massive funding request, including humanitarian aid, all the way back in October, and Congress has yet to authorize that, which makes it difficult for Biden to get any messages across. But in general, I think the undeclared vote was not the political earthquake that a lot of folks in that community wanted it to be. And I think that there should be a lot of breathing room for the Biden administration, understanding that they will not have to worry about a delegate from this contingency at the DNC this summer.
All right, so staying on the political front here, our good friends in Congress, I guess, are getting back to work today or tomorrow. Who knows? But
let's put that in quotes, yeah?
Yes.
Okay.
What are they going to do here about keeping this government open? Should the markets be concerned that we could have an issue here either this Friday or next Friday?
Next Friday would be a big issue, and it comes at a very precarious time for the Biden administration specifically. But here's the state of play as I understand it. We're going to get another short-term CR. It's just a matter of how long. This Friday's deadline only covers about 25% of U.S. federal spending. It is $321 billion, if I'm not mistaken. Next Friday is the big kahuna at $1.2 trillion. So I do think that there's going to be a deal to avert a shutdown this week. That's contrary to my earlier view. What happened is the House changed its schedule. They decided to actually come back into town, as you point out. Instead of being gone all week, they are coming back today so that they will be in a position to at least take some votes. But you can tell from Speaker Johnson's reticence to even release text that this is going to get slammed and daylight is going to kill it if he releases it too early. So we need to see text, no earlier than tonight, and a vote would come on Friday. But the potential for a short team CR is effectively guaranteed. The real linchpin here is that for the first time in 2 cycles, the Senate Republican Conference is really hoping not to lose their races through unforced errors or through endorsing MAGA candidates. This is their last best chance in a while, and they've got 8 Democratic seats in purple states that are highly at risk. On that list is Arizona, Michigan, Nevada, Wisconsin, Ohio, Pennsylvania, Montana, certainly. So the Senate Republicans are effectively trying to pull rank on House Republicans here and say, let me get a majority in Congress and in the U.S. Senate. Don't shut it down. Don't ruin our chances by making us all look dysfunctional. Let's keep the government open, eye on the prize, focus on the White House, focus on immigration, and move on from these, sort of futile efforts to cut federal spending from very popular programs like defense. So I think that is very helpful. I would like to see Minority Leader McConnell have a little bit more sway over House Republicans, and particularly Speaker Johnson. I think we will get there and we'll avoid a shutdown on Friday. And then optimistically, we'll avoid a bigger one next Friday. The one caveat, or the several caveats are, one, it's Super Tuesday next Tuesday. The president will deliver the State of the Union address on Thursday, and then that big shutdown would come on Friday. So there's a lot of moving parts here to be watching.
Oh, I love it. It's like, I don't want to be the most dysfunctional person in my party. Like, I think that's the bar for some. Hey, Henrietta, thanks a lot. Henrietta Trey is Managing Partner and Director of Economic Policy at Veda Partners. But I also wonder, we didn't get a chance to ask about Nikki Haley, but we know the nomination's not going to happen, but she keeps making the case, like 30 to 40% of the voters in this state don't want Trump. And I wonder how that eventually evolves over the next few months.
Yeah, and a lot of folks we talked to on the political front say that she may stay in this race longer, if for no other reason than to get to the convention and just kind of be there.
And just sit there and see what happens.
See what happens.
I've heard that too. I wonder what that winds up looking like, and if the polling winds up showing up other
The conventions this year are actually going to be very interesting, I think. I mean, I think both of them are going to be very interesting, and maybe not for the incumbents, but there's going to be a lot of rhetoric out there, so we'll pay attention to them this summer as we get closer to them. S&P 500 off 0.2%. NASDAQ off 0.5% here. We'll keep an eye on that. Yields steady, 10-year Treasury 4.29%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages lower right now. Interestingly, in the S&P 500, 8 of the 11 major industry groups are actually higher. Energy is in the lead, and the biggest drag that's coming from communication services. That's where you're going to find shares of Alphabet. Those shares right now down 1.7%. Apple holding its annual shareholder meetings. Its stock teeters near a critical technical support level, $180. And then you have some Fed speak today. I'm on the central bankers speaking. Raphael Bostic, Susan Collins, John Williams. And then Chrysler recalling more than 330,000 Jeep Grand Cherokees because of a steering wheel issue has caused drivers to lose control of their vehicles. S&P 500 right now, 12 points lower. That's down 0.25%. 5,065 on the index. The Dow Jones Industrial Average down 147 points. The NASDAQ 100, 104 points lower. Two-year yield, that's lower, down 2 basis points, 466. The 10 is down 1 basis points. That's at 428 right now. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. All right, Paramount, they are reporting earnings after the close, and it's probably not going to be a great print. A lot of these media companies are facing a lot of real headwinds to their operations, making that transition to streaming. Advertising's not great, cord cutting, all that kind of stuff we all know. But people are going to want to really get a sense of what Paramount's going to do going forward. Are they going to sell themselves, and if so, to whom? Geetha Ranganathan joins us. She is the media analyst at Bloomberg Intelligence. She's the expert. She joins us from the Bloomberg Intelligence HQ down in Princeton, New Jersey. Geetha, thanks so much for joining us here. First of all, just give us a sense of how the business is for Paramount. I mean, Paramount's the Viacom company. It's the CBS. They kind of put it all together, renamed it Paramount. How are those businesses doing these days?
Yeah, thank you, Paul. So, of course, all of these businesses, as you just pointed out, they are in the midst of this transition away from, the linear TV business model to the streaming or the direct-to-consumer model. And for Paramount, actually, that's kind of been a little bit of a mixed bag. So I say that because their subscriber numbers are not actually bad. They have a service out there called Paramount Plus. We're expecting that for the last quarter, they would have added about 4 million subs or so. They do have NFL games. They have some pretty compelling programming on the service. That gives them maybe about 67, 70 million subscribers. The question is that enough? The short answer is probably not, right? Because you're competing against services like Netflix, which has, 260 million subscribers. Disney Plus has about 150 million. So really not good enough when it comes to scale. But the bigger problem for Paramount is really the amount of money that they're losing on these services. So they've been bleeding cash. They lost about $1.8 billion last year just on Paramount Plus. They're going to lose a little bit less, but it's going to be a pretty similar amount, about 1.7 billion. That's what they've kind of guided to for this quarter. And the problem really is, for this year. And the problem is they're not really going to be break even for a long time on the streaming business. And that is what the street is focused on. So that's going to be a real pain point for them. And there's really no clear solution in sight.
Except potential takeover, right? I mean, wasn't that the rumor? Maybe we're going to have Warner Brothers Discover. Then we heard, no, that's not going to happen. I talked to Paul about this yesterday in terms of what are the actual options. Like, is this a big tech play? Does it have to come from private equity? Like, how do you even begin to think about who would want this thing?
Yeah, there's just been so many rumors, Alex, swirling around for the past 2-3 months. We had that news about